1. Understanding compound interest. 1.1 What is compound interest? Compound interest is a powerful financial concept that plays a significant role in wealth accumulation and financial planning. It is a fundamental principle that allows individuals to grow their money exponentially over time. Understanding compound interest is essential for anyone seeking to build wealth and achieve financial independence. Compound interest is the interest earned not only on the initial amount of money invested or deposited but also on the accumulated interest from previous periods. In simple terms, it is interest on interest. This compounding effect can significantly boost the growth of your investments or savings over the long term. To illustrate the concept of compound interest, let's consider a hypothetical scenario. Suppose you invest $10,000 in a savings account that offers an annual interest rate of 5%. At the end of the first year, you would earn $500 in interest, bringing your total balance to $10,500. In the second year, the interest is calculated not only on the initial $10,000 but also on the additional $500 earned in the first year. Therefore, you would earn $525 in interest, resulting in a total balance of $11,025. This process continues, and with each passing year, the interest earned becomes a larger portion of your total balance, leading to exponential growth. The power of compound interest lies in the fact that it allows your money to work for you, generating additional income without any additional effort on your part. As time goes on, the compounding effect becomes more pronounced, and your wealth grows at an accelerating rate. This is why starting early and giving your investments or savings time to compound is crucial. Compound interest is not limited to savings accounts. It applies to various financial instruments such as stocks, bonds, mutual funds, and retirement accounts. By harnessing the power of compound interest, you can make your money work harder and achieve your financial goals more efficiently. Understanding how compound interest works is essential for making informed financial decisions. It enables you to evaluate the potential growth of your investments and make strategic choices based on long-term goals. By taking advantage of compound interest, you can maximize your returns and build wealth over time. To calculate compound interest, a formula is used. A equals P 1 plus R N caret NT. Where A is the future value of the investment or savings, P is the principal amount, initial investment or deposit, R is the annual interest rate, expressed as a decimal, N is the number of times interest is compounded per year, T is the number of years the money is invested or saved. The formula allows you to determine the future value of your investment or savings by considering the principal amount, the interest rate, the compounding frequency, and the time period. It provides a clear understanding of how your money will grow over time and helps you make informed decisions about your financial strategy. In conclusion, compound interest is a powerful tool for wealth accumulation and financial planning. It allows your money to grow exponentially over time by earning interest on both the initial amount and the accumulated interest. Understanding the concept of compound interest is crucial for making informed financial decisions and maximizing the growth of your investments or savings. By harnessing the power of compound interest, you can build wealth, achieve financial independence, and secure a prosperous future. 1.2 The power of compound interest. Compound interest is a powerful force that can significantly impact your financial future. It is often referred to as the eighth wonder of the world, and for good reason. Understanding the power of compound interest is essential for anyone looking to build wealth and achieve financial independence. 1.2.1 What is compound interest? Compound interest is the concept of earning interest on both the initial amount of money invested or saved, as well as the accumulated interest from previous periods. In simple terms, it means that your money can grow exponentially over time. Unlike simple interest, which only calculates interest on the principal amount, compound interest takes into account the interest earned in previous periods. This compounding effect allows your money to grow at an accelerated rate, especially over long periods. 1.2.2 The time factor. One of the key factors that make compound interest so powerful is time. The longer your money is invested or saved, the more time it has to compound and grow. This is why starting early is crucial when it comes to harnessing the power of compound interest. Let's consider an example to illustrate the impact of time on compound interest. Suppose you invest $10,000 at an annual interest rate of 5%. After 1 year, you would earn $500 in interest, resulting in a total of $10,500. However, if you leave that money invested for another year, you would earn interest not only on the initial $10,000 but also on the $500 interest earned in the first year. This compounding effect continues to grow over time, allowing your money to work harder for you. 1.2.3 The snowball effect. Compound interest has a snowball effect, meaning that as your money grows, the amount of interest earned also increases. This creates a positive feedback loop where your wealth accumulates at an accelerating rate. To better understand the snowball effect, let's consider another example. Suppose you invest $1,000 at an annual interest rate of 8%. After 10 years, your investment would grow to approximately $2,158.92. However, if you continue to leave that money invested for another 10 years, your investment would grow to approximately $4,661.39. The longer you leave your money invested, the more significant the snowball effect becomes. 1.2.4 Harnessing compound interest for wealth building. The power of compound interest lies in its ability to generate passive income and build wealth over time. By consistently saving or investing and allowing your money to compound, you can create a solid foundation for financial success. To harness the power of compound interest for wealth building, it is important to start early, be consistent, and have a long-term perspective. The earlier you start, the more time your money has to grow. Being consistent with your savings or investment contributions ensures a steady stream of funds to compound. And having a long-term perspective allows you to ride out market fluctuations and benefit from the compounding effect. 1.2.5 The impact of compound interest on debt. Compound interest not only applies to investments and savings but also to debt. When you borrow money, the interest on the loan compounds over time, increasing the total amount you owe. Understanding the impact of compound interest on debt is crucial for managing your finances effectively. By paying off high-interest debt as quickly as possible, you can minimize the compounding effect and save money in the long run. 1.2.6 The importance of consistency. Consistency is key when it comes to harnessing the power of compound interest. Whether it's saving, investing, or paying off debt, being consistent with your efforts will yield the best results. Consistent saving or investing allows your money to compound over time, maximizing its growth potential. Regularly contributing to your investments or savings accounts ensures a steady stream of funds to take advantage of the compounding effect. Similarly, consistent debt repayment helps minimize the impact of compound interest on the total amount owed. By making regular payments and avoiding late fees or penalties, you can effectively manage your debt and reduce the overall interest paid. 1.2.7 Conclusion. Compound interest is a powerful tool that can significantly impact your financial well-being. By understanding its mechanics and harnessing its power, you can build wealth, achieve financial independence, and secure a brighter future. Remember, the key to success lies in starting early, being consistent, and having a long-term perspective. So, take advantage of the power of compound interest and start compounding your wealth today. 1.3 How compound interest works. Compound interest is a powerful financial concept that allows individuals to grow their wealth exponentially over time. It is the process of earning interest on both the initial principal amount and the accumulated interest from previous periods. In simple terms, compound interest is interest on interest. 1.3.1 The basics of compound interest. To understand how compound interest works, let's consider a hypothetical scenario. Imagine you have $1,000 that you decide to invest in a savings account that offers an annual interest rate of 5%. At the end of the first year, you would earn $50 in interest, bringing your total balance to $1,050. Now, instead of withdrawing the interest, you decide to leave it in the account and let it compound. In the second year, you would earn interest not only on your initial $1,000 but also on the $50 of interest from the previous year. Assuming the interest rate remains the same, you would earn $52.50 in interest, bringing your total balance to $1,102.50. This compounding process continues year after year, with each year's interest being added to the principal amount. Over time, the interest earned becomes more significant, and your wealth grows at an accelerating rate. 1.3.2 The power of time in compound interest. One of the key factors that make compound interest so powerful is time. The longer you allow your money to compound, the greater the impact on your wealth. This is due to the exponential growth nature of compound interest. Let's consider two individuals, John and Sarah, who both invest $10,000 at an annual interest rate of 8%. John decides to leave his money invested for 20 years, while Sarah withdraws her money after just 10 years. After 10 years, John's investment would have grown to approximately $21,589. However, Sarah, who withdrew her money, would only have $21,589. The additional 10 years of compounding made a significant difference in John's final balance. This example illustrates the power of time in compound interest. The longer you allow your money to grow, the more substantial the returns become. It emphasizes the importance of starting early and being patient when it comes to investing. 1.3.3 The effect of interest rates on compound interest. Another crucial factor in understanding how compound interest works is the interest rate. The interest rate determines the rate at which your money grows over time. A higher interest rate leads to faster growth, while a lower interest rate results in slower growth. Let's consider two individuals, Mark and Lisa, who both invest $5,000. Mark chooses an investment with an annual interest rate of 10%, while Lisa opts for an investment with an annual interest rate of 5%. Both investments compound annually. After 20 years, Mark's investment would have grown to approximately $34,433, while Lisa's investment would only be around $12,763. The difference in interest rates resulted in a significant disparity in their final balances. This example highlights the impact of interest rates on compound interest. Even a small difference in interest rates can lead to substantial differences in wealth accumulation over time. It is essential to consider the interest rate when making investment decisions to maximize the power of compound interest. 1.3.4 The frequency of compounding. The frequency at which interest is compounded also plays a role in how compound interest works. Compounding can occur annually, semi-annually, quarterly, monthly, or even daily, depending on the financial institution or investment vehicle. Generally, the more frequently interest is compounded, the faster your money grows. For example, if you have an investment that compounds annually and another that compounds monthly, both with the same interest rate, the monthly compounding investment will yield a higher final balance. This is because with monthly compounding, your money has more opportunities to earn interest throughout the year. The interest earned in each compounding period is added to the principal, allowing for more significant growth over time. However, it's important to note that the difference in final balances due to compounding frequency becomes less significant as the investment period lengthens. Over longer periods, the impact of compounding frequency diminishes, and the interest rate becomes the primary driver of growth. 1.3.5 The Rule of 72. The Rule of 72 is a handy tool for estimating the time it takes for an investment to double based on the compound interest rate. By dividing 72 by the interest rate, you can approximate the number of years it will take for your investment to double. For example, if you have an investment with a compound interest rate of 8%, dividing 72 by 8 gives you 9. This means it would take approximately 9 years for your investment to double. The Rule of 72 provides a quick and easy way to understand the impact of compound interest on your investments. It helps you gauge the potential growth of your money and make informed decisions about your financial goals. In conclusion, compound interest is a powerful tool for wealth accumulation. By allowing your money to grow through compounding over time, you can harness the exponential growth potential and achieve your financial goals faster. Understanding how compound interest works and leveraging it effectively can pave the way to financial success. 1.4 The Formula for Compound Interest. Compound interest is a powerful concept that allows individuals to grow their wealth exponentially over time. Understanding the formula for compound interest is essential for anyone looking to take advantage of this financial tool. In this section, we will explore the formula for compound interest and how it can be used to calculate the future value of an investment. The formula for compound interest is A equals P 1 plus R N caret NT, where A is the future value of the investment loan, including interest. P is the principal amount, the initial investment loan amount. R is the annual interest rate, expressed as a decimal. N is the number of times that interest is compounded per year. T is the number of years the money is invested, borrowed for. Let's break down the formula and understand each component. Principal amount. P. The principal amount refers to the initial investment or loan amount. It is the starting point for calculating compound interest. For example, if you invest $10,000 in a savings account, the principal amount would be $10,000. Annual interest rate. R. The annual interest rate is the rate at which the investment grows or the cost of borrowing money. It is expressed as a decimal. For instance, if the annual interest rate is 5%, it would be represented as 0.05 in the formula. Compounding frequency. N. Compounding frequency refers to how often the interest is compounded within a year. It can be annually, semi-annually, quarterly, monthly, or even daily. The more frequently interest is compounded, the faster the investment grows. In the formula, N represents the number of times interest is compounded per year. Time. T. Time represents the number of years the money is invested or borrowed for. It is an essential factor in determining the growth of an investment. The longer the money is invested, the more time it has to compound and grow. In the formula, T represents the number of years. Now, let's see the formula in action with an example. Suppose you invest $5,000 in a savings account with an annual interest rate of 6%, compounded annually, for a period of 10 years. Using the compound interest formula, we can calculate the future value of your investment. A equals 5,000, 1 plus 0.061 caret 1 asterisk 10. A equals 5,000, 1 plus 0.06 caret 10. A equals 5,000, 1.06 caret 10. A equals 5,000, 1.790847. A equals $8,954.24. Therefore, after 10 years, your initial investment of $5,000 would grow to approximately $8,954.24. It is important to note that the formula for compound interest assumes that no additional contributions or withdrawals are made during the investment period. If you make regular contributions or withdrawals, the calculation becomes more complex and requires additional formulas. Understanding the formula for compound interest empowers individuals to make informed financial decisions. It allows them to estimate the future value of their investments and make strategic choices based on their financial goals. By harnessing the power of compound interest, individuals can take control of their financial future and work towards building long-term wealth. 2. The benefits of compound interest. 2.1 Building wealth with compound interest. Compound interest is a powerful financial concept that can help individuals build wealth over time. By understanding and harnessing the power of compound interest, you can make your money work for you and achieve your financial goals. In this section, we will explore how compound interest can be used as a tool for building wealth. 2.1.1 The basics of compound interest. Compound interest is the process of earning interest on both the initial amount of money invested, known as the principal, and the accumulated interest from previous periods. Unlike simple interest, which only calculates interest on the principal amount, compound interest allows your money to grow exponentially over time. To illustrate the power of compound interest, let's consider an example. Suppose you invest $10,000 in an account that earns an annual interest rate of 5%. At the end of the first year, you would earn $500 in interest, bringing your total balance to $10,500. In the second year, you would earn interest not only on the initial $10,000 but also on the additional $500 of interest earned in the first year. This compounding effect continues year after year, resulting in exponential growth of your investment. 2.1.2 The time factor. One of the key factors that determine the effectiveness of compound interest is time. The longer your money remains invested, the more time it has to grow and compound. This is why starting early is crucial when it comes to building wealth with compound interest. Let's consider two individuals, Alex and Ben, who both want to save for retirement. Alex starts investing $5,000 per year at the age of 25 and continues until the age of 35, for a total of 10 years. Ben, on the other hand, starts investing the same amount at the age of 35 and continues until the age of 65, for a total of 30 years. Assuming an annual interest rate of 7%, Alex would have accumulated approximately $787,000 by the age of 65, while Ben would have accumulated around $602,000. This example demonstrates the power of compound interest over time. Even though Alex invested a smaller total amount, the compounding effect over a longer period allowed his investment to grow significantly more than Ben's. 2.1.3 Consistent contributions. Another important aspect of building wealth with compound interest is making consistent contributions. By regularly adding to your investment, you can accelerate the growth of your wealth. This can be achieved through systematic investment plans or automatic contributions to retirement accounts. Let's consider an example to illustrate this point. Suppose you invest $1,000 per month in a retirement account that earns an annual interest rate of 6%. After 30 years, your total investment would amount to $360,000. However, due to the power of compound interest, your account balance would be significantly higher, potentially reaching over $1 million. By consistently contributing to your investment over time, you not only benefit from the compounding effect but also take advantage of dollar cost averaging. This strategy allows you to buy more shares when prices are low and fewer shares when prices are high, potentially increasing your overall returns. 2.1.4 Reinvesting dividends and interest. Another way to maximize the benefits of compound interest is by reinvesting dividends and interest earned from your investments. Instead of withdrawing these earnings, you can choose to reinvest them back into your portfolio. This allows your investment to grow at an accelerated rate, as the reinvested earnings also generate additional returns. For example, let's say you own shares of a dividend-paying stock. Instead of receiving the dividend as cash, you can opt to reinvest it by purchasing more shares of the same stock. Over time, the compounding effect of reinvesting dividends can significantly boost your investment returns. The same principle applies to interest earned from fixed income investments such as bonds or certificates of deposit. By reinvesting the interest earned, you can take advantage of compound interest and accelerate the growth of your investment. 2.1.5 Diversification and compound interest. Diversification is another important aspect of building wealth with compound interest. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the risk of loss and potentially enhance your overall returns. When it comes to compound interest, diversification allows you to benefit from the compounding effect in various investment vehicles. By diversifying your portfolio, you can take advantage of the growth potential of different assets, such as stocks, bonds, mutual funds, and real estate. Diversification also helps to mitigate the impact of market fluctuations on your investment returns. By spreading your investments, you reduce the risk of being heavily exposed to a single asset or sector. This can help protect your wealth and ensure a more stable growth trajectory over time. 2.1.6 The power of patience. Building wealth with compound interest requires patience and a long-term perspective. It is important to resist the temptation to make impulsive investment decisions based on short-term market fluctuations. Instead, focus on the long-term growth potential of your investments and stay committed to your financial goals. By staying invested and allowing compound interest to work its magic over time, you can harness the power of exponential growth and build substantial wealth. Remember, compound interest is a marathon, not a sprint. The key is to start early, make consistent contributions, and remain patient throughout your investment journey. In the next section, we will explore the relationship between compound interest and long-term investing. We will discuss how compound interest can be leveraged to maximize returns and achieve financial independence. 2.2 Long-term investing and compound interest. Investing is a powerful tool for building wealth, and when combined with the concept of compound interest, it becomes even more potent. Compound interest allows your investments to grow exponentially over time, as the interest earned is reinvested and starts earning interest of its own. This compounding effect can have a significant impact on your long-term financial goals. 2.2.1 The magic of time. One of the key factors that make compound interest so effective is time. The longer you stay invested, the more time your money has to grow and compound. This is why starting early is crucial when it comes to long-term investing. Even small amounts invested regularly can accumulate into substantial sums over time. Let's consider an example to illustrate the power of time and compound interest. Suppose you start investing $100 per month at the age of 25 and continue until you retire at 65. Assuming an average annual return of 8%, your investment would grow to approximately $472,000. However, if you delay starting until the age of 35, your investment would only grow to around $213,000. The 10-year difference in starting age results in a significant disparity in the final amount accumulated. 2.2.2 The benefits of dollar cost averaging. Another advantage of long-term investing is the ability to take advantage of dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market conditions. This approach allows you to buy more shares when prices are low and fewer shares when prices are high. By consistently investing over the long term, you reduce the impact of short-term market fluctuations. This strategy helps smooth out the volatility of the market and can potentially lead to higher returns over time. Additionally, dollar cost averaging eliminates the need to time the market, which is notoriously difficult to do consistently. 2.2.3 The power of compounding returns. Compound interest not only allows your initial investment to grow but also amplifies the returns generated by your investments. As your investment gains accumulate, they generate additional returns, which are then reinvested and continue to compound. Over time, this compounding effect can significantly boost your overall investment returns. For example, let's say you invest $10,000 in a stock that generates an average annual return of 10%. After the first year, your investment would grow to $11,000. In the second year, you would earn a return of 10% on $11,000, resulting in a gain of $1,100 and a total investment value of $12,100. As this process continues, the compounding returns become more substantial, leading to exponential growth in your investment. 2.2.4 The importance of patience and discipline. Long-term investing requires patience and discipline. It's essential to stay focused on your long-term goals and avoid making impulsive decisions based on short-term market fluctuations. Market volatility is a natural part of investing, and trying to time the market can often lead to poor investment outcomes. Instead, it's crucial to adopt a long-term perspective and stay invested through market ups and downs. By maintaining a diversified portfolio and regularly contributing to your investments, you can take advantage of the power of compound interest and potentially achieve your financial goals. 2.2.5 The role of asset allocation. When it comes to long-term investing and compound interest, asset allocation plays a vital role. Asset allocation refers to the distribution of your investments across different asset classes, such as stocks, bonds, and real estate. The goal of asset allocation is to create a balanced portfolio that maximizes returns while minimizing risk. By diversifying your investments across various asset classes, you can reduce the impact of market volatility on your overall portfolio. Different asset classes tend to perform differently under various market conditions, and by spreading your investments, you can potentially mitigate the risk associated with any single investment. 2.2.6 The power of reinvesting dividends. Dividends are a portion of a company's profits that are distributed to shareholders. When investing in dividend-paying stocks, you have the option to reinvest those dividends back into the same stock or use them to purchase additional shares of different stocks. Reinvesting dividends can significantly enhance the power of compound interest. By reinvesting dividends, you are effectively compounding your returns. The additional shares purchased through dividend reinvestment start earning their own dividends, which are then reinvested, leading to even more shares and dividends. Over time, this compounding effect can have a substantial impact on the growth of your investment portfolio. 2.2.7 Long-term investing for retirement. Compound interest and long-term investing go hand in hand when it comes to retirement planning. The earlier you start investing for retirement, the more time your investments have to grow and compound. By consistently contributing to retirement accounts such as 401ks or IRAs, you can take advantage of the tax benefits and potential employer matching contributions. Long-term investing for retirement requires a strategic approach. It's essential to determine your retirement goals, estimate your future expenses, and create a plan to achieve those goals. By incorporating compound interest into your retirement strategy, you can potentially build a substantial nest egg that will provide for a comfortable retirement. In conclusion, long-term investing and compound interest are powerful tools for building wealth. By starting early, staying invested, diversifying your portfolio, and reinvesting dividends, you can harness the power of compound interest to achieve your financial goals. Patience, discipline, and a long-term perspective are key to maximizing the benefits of compound interest and securing your financial future. 2.3 Compound interest and retirement planning. Retirement planning is a crucial aspect of financial management that requires careful consideration and strategic decision-making. One of the most powerful tools in retirement planning is compound interest. Compound interest allows individuals to grow their retirement savings exponentially over time by reinvesting the interest earned on their initial investment. 2.3.1 The power of compound interest in retirement planning. Compound interest has a profound impact on retirement planning due to its ability to generate exponential growth. When individuals contribute to their retirement accounts, such as a 401k or an individual retirement account (IRA), the money is invested and earns interest over time. This interest is then reinvested, allowing the account balance to grow at an accelerated rate. The power of compound interest lies in the compounding effect, where the interest earned on the initial investment is added to the principal, resulting in a larger base for future interest calculations. As time goes on, the interest earned on the accumulated interest becomes increasingly significant, leading to exponential growth in the retirement account. 2.3.2 Starting early, the key to maximizing compound interest in retirement planning. One of the most critical factors in maximizing the benefits of compound interest in retirement planning is starting early. The earlier individuals begin saving for retirement, the longer their investments have to grow and compound. Time is a crucial component in the equation of compound interest, as it allows for more compounding periods and a higher overall return. By starting early, individuals can take advantage of the power of compounding over a more extended period. Even small contributions made consistently over time can lead to substantial growth due to the compounding effect. This is why financial advisors often stress the importance of starting to save for retirement as soon as possible. 2.3.3 Regular contributions and compound interest in retirement planning. In addition to starting early, making regular contributions to retirement accounts is another key aspect of maximizing compound interest in retirement planning. By consistently adding to the retirement savings, individuals can increase the principal amount, which in turn leads to higher interest earnings. Regular contributions allow individuals to take full advantage of the compounding effect. As the account balance grows, the interest earned on the larger principal becomes more significant. By contributing consistently, individuals can harness the power of compound interest to build a substantial retirement nest egg. 2.3.4 The role of investment returns in compound interest and retirement planning. While regular contributions are essential, the investment returns earned on retirement savings also play a significant role in retirement planning. The rate of return on investments determines the growth potential of the retirement account and the overall impact of compound interest. Investing in a diversified portfolio that aligns with an individual's risk tolerance and retirement goals is crucial. By selecting investments that have historically provided higher returns, individuals can maximize the growth potential of their retirement savings. Higher investment returns mean more significant compounding effects, leading to a more substantial retirement fund. 2.3.5 Balancing risk and reward in retirement planning. Retirement planning involves finding the right balance between risk and reward. While higher risk investments may offer the potential for higher returns, they also come with increased volatility and the possibility of losses. On the other hand, lower risk investments may provide more stability but offer lower returns. When considering compound interest in retirement planning, individuals need to assess their risk tolerance and investment goals. It is essential to strike a balance between conservative and growth-oriented investments to ensure the retirement portfolio can withstand market fluctuations while still benefiting from the power of compound interest. 2.3.6 The impact of inflation on retirement planning. Inflation is another crucial factor to consider when incorporating compound interest into retirement planning. Inflation erodes the purchasing power of money over time, meaning that the same amount of money will buy less in the future. Therefore, it is essential to account for inflation when setting retirement goals and determining the required rate of return on investments. By considering the impact of inflation, individuals can adjust their retirement savings goals and investment strategies accordingly. It is crucial to aim for a rate of return that exceeds the inflation rate to ensure that the retirement savings can maintain its purchasing power over time. 2.3.7 The importance of monitoring and adjusting retirement plans. Retirement planning is not a one-time event but an ongoing process. It is crucial to regularly monitor and adjust retirement plans to ensure they remain on track. As individuals progress through different life stages and experience changes in income, expenses, and investment goals, their retirement plans may need to be modified accordingly. Monitoring the performance of retirement investments and making necessary adjustments can help individuals stay on course to achieve their retirement goals. By staying proactive and regularly reviewing the retirement plan, individuals can make informed decisions and take advantage of opportunities to maximize compound interest. 2.3.8 Seeking professional advice for retirement planning. Retirement planning can be complex, and the decisions made can have a significant impact on an individual's financial future. Seeking professional advice from a financial advisor or retirement planner can provide valuable insights and guidance. A financial professional can help individuals assess their retirement goals, determine the appropriate investment strategies, and create a comprehensive retirement plan that incorporates compound interest effectively. They can also provide ongoing support and guidance, ensuring that the retirement plan remains aligned with the individual's changing needs and circumstances. In conclusion, compound interest plays a vital role in retirement planning. By starting early, making regular contributions, and selecting appropriate investments, individuals can harness the power of compound interest to build a substantial retirement nest egg. Balancing risk and reward, considering inflation, and seeking professional advice are also crucial aspects of effective retirement planning. By understanding and utilizing compound interest, individuals can take control of their financial future and enjoy a comfortable retirement. 2.4 Compound interest and financial independence. Financial independence is a goal that many individuals strive to achieve. It represents the ability to live comfortably and sustainably without relying on a traditional job or a regular paycheck. Compound interest plays a crucial role in attaining financial independence by allowing your money to work for you and grow exponentially over time. 2.4.1 The power of compound interest in building wealth. Compound interest is often referred to as the eighth wonder of the world because of its remarkable ability to multiply wealth. It is the concept of earning interest on both the initial principal amount and the accumulated interest from previous periods. This compounding effect can significantly accelerate the growth of your investments. To understand the power of compound interest, let's consider an example. Suppose you invest $10,000 in an account that earns an annual interest rate of 8%. At the end of the first year, you would earn $800 in interest, bringing your total balance to $10,800. In the second year, you would earn 8% interest on the new balance of $10,800, resulting in an additional $864. Over time, this compounding effect continues to snowball, and your wealth grows exponentially. 2.4.2 Harnessing compound interest for financial independence. Financial independence is achieved when your passive income, generated from investments and assets, covers your living expenses. Compound interest can be a powerful tool in helping you reach this goal. By consistently saving and investing a portion of your income, you can take advantage of compound interest to grow your wealth over time. The key is to start early and be consistent. The longer your money has to compound, the greater the impact it will have on your financial independence. 2.4.3 The role of time in compound interest. Time is a critical factor when it comes to compound interest. The longer your money is invested, the more time it has to grow and compound. Starting early allows you to take advantage of the compounding effect over a more extended period. Even small contributions made consistently over a long period can lead to significant wealth accumulation. By starting early, you can benefit from the power of compound interest and potentially achieve financial independence sooner. 2.4.4 Investing strategies for financial independence. To harness the full potential of compound interest for financial independence, it is essential to develop a sound investment strategy. Here are a few strategies to consider. Diversification. Diversification is the practice of spreading your investments across different asset classes, such as stocks, bonds, real estate, and mutual funds. By diversifying your portfolio, you can reduce the risk of any single investment negatively impacting your overall wealth. Diversification helps to ensure a more stable and consistent growth of your investments over time. Long-term investing. Investing with a long-term perspective is crucial for financial independence. Short-term market fluctuations can be unpredictable, but over the long term, the stock market has historically shown positive growth. By staying invested for the long haul, you can ride out market volatility and benefit from the compounding effect of compound interest. Regular contributions. Consistently contributing to your investment portfolio is another key strategy for financial independence. By making regular contributions, you can take advantage of dollar-cost averaging. This strategy involves investing a fixed amount at regular intervals, regardless of market conditions. Over time, this approach can help smooth out the impact of market fluctuations and maximize the benefits of compound interest. 2.4.5 Monitoring and adjusting your compound interest plan. As you progress towards financial independence, it is crucial to regularly monitor and adjust your compound interest plan. Here are a few considerations. Reviewing investment performance. Periodically review the performance of your investments to ensure they align with your financial goals. If certain investments are consistently underperforming, it may be necessary to make adjustments to your portfolio. Rebalancing. Rebalancing involves adjusting the allocation of your investments to maintain the desired level of risk and return. As some investments outperform others, your portfolio's asset allocation may shift. Rebalancing helps to realign your investments with your long-term financial goals. Seeking professional advice. If you are unsure about managing your investments or need guidance on your path to financial independence, consider seeking advice from a financial advisor. They can provide personalized recommendations based on your unique circumstances and help you optimize your compound interest strategy. In conclusion, compound interest is a powerful tool that can help you achieve financial independence. By harnessing the compounding effect, starting early, and implementing sound investment strategies, you can build wealth over time and create a sustainable income stream that supports your desired lifestyle. Remember, financial independence is within reach with the right mindset, discipline, and a well-executed compound interest plan. 3. Maximizing compound interest. 3.1 Strategies for maximizing compound interest. Compound interest is a powerful tool that can help individuals grow their wealth over time. By reinvesting the interest earned on an initial investment, individuals can benefit from exponential growth. However, in order to maximize the potential of compound interest, it is important to employ effective strategies. In this section, we will explore some key strategies for maximizing compound interest. 3.1.1 Start early. One of the most important strategies for maximizing compound interest is to start investing early. The earlier you begin investing, the more time your money has to grow. This is due to the compounding effect, where the interest earned on your initial investment is reinvested and earns additional interest. By starting early, even with small amounts, you can take advantage of the power of compounding over a longer period of time. 3.1.2 Increase the frequency of contributions. Another strategy for maximizing compound interest is to increase the frequency of your contributions. Instead of making a single lump sum investment, consider making regular contributions to your investment account. This allows you to take advantage of the compounding effect more frequently. By contributing on a monthly or quarterly basis, you can ensure that your investment is constantly growing and compounding. 3.1.3 Reinvest dividends and interest. When investing in stocks, bonds, or mutual funds, it is common to receive dividends or interest payments. Instead of withdrawing these payments, a strategy for maximizing compound interest is to reinvest them. By reinvesting dividends and interest, you can increase the size of your investment and benefit from compounding. This can significantly boost your overall returns over time. 3.1.4 Take advantage of tax-advantaged accounts. Tax-advantaged accounts, such as 401k plans, individual retirement accounts (IRAs), and Roth IRAs, offer significant benefits for maximizing compound interest. Contributions to these accounts are often tax-deductible or tax-free, allowing your investments to grow without the burden of taxes. By taking advantage of these accounts, you can maximize the growth potential of your investments and compound interest. 3.1.5 Diversify your investments. Diversification is a key strategy for maximizing compound interest and reducing risk. By spreading your investments across different asset classes, sectors, and geographic regions, you can minimize the impact of any single investment on your overall portfolio. Diversification helps to protect your investments from market volatility and allows you to benefit from the growth potential of different sectors and regions. 3.1.6 Regularly review and adjust your portfolio. To maximize compound interest, it is important to regularly review and adjust your investment portfolio. Market conditions, economic factors, and personal circumstances can change over time, and it is important to ensure that your investments align with your goals and risk tolerance. By regularly reviewing your portfolio, you can make necessary adjustments to maximize the growth potential of your investments and compound interest. 3.1.7 Minimize fees and expenses. Fees and expenses can eat into your investment returns and reduce the power of compound interest. It is important to carefully consider the fees associated with your investments and choose low-cost options whenever possible. By minimizing fees and expenses, you can maximize the growth potential of your investments and compound interest. 3.1.8 Stay disciplined and patient. Maximizing compound interest requires discipline and patience. It is important to stay committed to your investment strategy and avoid making impulsive decisions based on short-term market fluctuations. By staying disciplined and patient, you can ride out market volatility and benefit from the long-term growth potential of compound interest. In conclusion, maximizing compound interest requires a combination of strategies. Starting early, increasing the frequency of contributions, reinvesting dividends and interest, taking advantage of tax-advantaged accounts, diversifying investments, regularly reviewing and adjusting your portfolio, minimizing fees and expenses, and staying disciplined and patient are all key strategies for maximizing compound interest. By implementing these strategies, individuals can harness the power of compound interest to grow their wealth over time. 3.2 Choosing the right investments for compound interest. When it comes to maximizing compound interest, one of the most crucial decisions you will make is choosing the right investments. The investments you select will determine the growth potential of your money and ultimately impact the amount of wealth you can accumulate over time. In this section, we will explore some key factors to consider when choosing investments for compound interest. 3.2.1 Investment Objectives. Before diving into specific investment options, it is essential to define your investment objectives. What are you trying to achieve with your investments? Are you looking for long-term growth, income generation, or a combination of both? Understanding your investment goals will help you determine the most suitable investment vehicles for your needs. 3.2.2 Risk Tolerance. Another critical factor to consider when choosing investments is your risk tolerance. Different investments come with varying levels of risk, and it is essential to align your investment choices with your comfort level. Generally, investments with higher potential returns tend to carry higher risks. It is crucial to strike a balance between risk and reward that aligns with your financial goals and risk tolerance. 3.2.3 Diversification. Diversification is a fundamental principle of investing and plays a crucial role in maximizing compound interest. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the overall risk in your portfolio. Diversification helps protect your investments from the impact of any single investment's poor performance. It is advisable to diversify your investments to minimize risk and maximize potential returns. 3.2.4 Asset Allocation. Asset allocation refers to the distribution of your investments across different asset classes, such as stocks, bonds, real estate, and cash. The right asset allocation strategy depends on your investment goals, risk tolerance, and time horizon. Generally, younger investors with a longer time horizon can afford to take more risks and allocate a higher percentage of their portfolio to stocks. As you approach retirement or have a shorter time horizon, it may be prudent to shift towards more conservative investments like bonds and cash. 3.2.5 Investment Options. Now let's explore some common investment options that can help you maximize compound interest. 3.2.5.1 Stocks. Stocks represent ownership in a company and offer the potential for significant long-term growth. Investing in individual stocks requires careful research and analysis to identify companies with strong growth prospects. Alternatively, you can invest in diversified portfolios of stocks through mutual funds or exchange-traded funds, ETFs. Stocks can be volatile in the short term but have historically provided higher returns over the long term. 3.2.5.2 Bonds. Bonds are fixed-income securities issued by governments, municipalities, and corporations. They offer regular interest payments and return the principal amount at maturity. Bonds are generally considered less risky than stocks and provide a more stable income stream. They can be an essential component of a well-diversified portfolio, especially for investors seeking income and capital preservation. 3.2.5.3 Real estate investments. Investing in real estate can provide both income and potential appreciation over time. Real estate investments can take various forms, including rental properties, real estate investment trusts, REITs, and real estate crowdfunding platforms. Real estate can offer diversification benefits and act as a hedge against inflation. However, it is essential to carefully evaluate the risks and potential returns associated with specific real estate investments. 3.2.5.4 Mutual funds and ETFs. Mutual funds and ETFs pool money from multiple investors to invest in a diversified portfolio of securities. They offer instant diversification and professional management, making them suitable for investors seeking exposure to various asset classes. Mutual funds are actively managed, while ETFs are passively managed and trade on stock exchanges. Both options provide access to a wide range of investment opportunities and can be an efficient way to maximize compound interest. 3.2.5.5 Index funds. Index funds are a type of mutual fund or ETF that aims to replicate the performance of a specific market index, such as the S&P 500. These funds offer broad market exposure and low expense ratios. Index funds are popular among investors who prefer a passive investment approach and want to capture the overall market's returns. They can be an excellent choice for long-term investors looking to maximize compound interest while keeping costs low. 3.2.6 Professional advice. Choosing the right investments for compound interest can be a complex task. It is advisable to seek professional advice from a financial advisor or investment professional who can help you navigate the investment landscape. A qualified advisor can assess your financial situation, risk tolerance, and investment goals to provide personalized recommendations tailored to your needs. Remember, the key to maximizing compound interest is to choose investments that align with your goals, diversify your portfolio, and regularly review and adjust your investment strategy as needed. By making informed investment decisions and staying committed to your long-term plan, you can harness the power of compound interest to build wealth over time. 3.3 The role of time in compound interest. Time is a crucial factor when it comes to the power of compound interest. The longer you allow your investments to grow, the greater the impact of compounding. Understanding the role of time in compound interest is essential for maximizing your wealth accumulation and achieving your financial goals. 3.3.1 The time value of money. The concept of the time value of money is fundamental to understanding the role of time in compound interest. The time value of money states that a dollar received today is worth more than a dollar received in the future. This is because money has the potential to grow over time through investments and earning compound interest. When it comes to compound interest, the longer your money is invested, the more time it has to grow and compound. This means that the earlier you start investing, the more significant the impact of compound interest on your wealth accumulation. 3.3.2 The power of compounding over time. Compound interest has a compounding effect on your investments. As your initial investment earns interest, that interest is reinvested and starts earning its own interest. Over time, this compounding effect can significantly increase the value of your investments. To illustrate the power of compounding over time, let's consider an example. Suppose you invest $10,000 at an annual interest rate of 5%. After 1 year, your investment would grow to $10,500. In the second year, you would earn interest not only on your initial $10,000 but also on the $500 of interest earned in the first year. This compounding effect continues to grow exponentially over time. The longer your money remains invested, the more time it has to compound and grow. This is why starting early and allowing your investments to grow over a long period is crucial for maximizing the benefits of compound interest. 3.3.3 The impact of time on risk. Time also plays a role in managing the risk associated with investments. Generally, the longer your investment horizon, the more time you have to ride out market fluctuations and recover from any potential losses. This is particularly important when investing in assets with higher volatility, such as stocks. By investing for the long term, you can reduce the impact of short-term market fluctuations on your overall investment performance. Over time, the potential for higher returns through compound interest can help offset any temporary market downturns. 3.3.4 The effect of time on financial goals. Time is a critical factor in achieving your financial goals through compound interest. The earlier you start investing, the more time you have to accumulate wealth and reach your desired financial milestones. Whether your goal is to save for retirement, purchase a home, or fund your children's education, the longer your investment horizon, the more time you have to grow your investments through compound interest. Starting early and consistently contributing to your investments over time can make a significant difference in achieving your financial objectives. 3.3.5 The importance of patience and discipline. Time in compound interest requires patience and discipline. It can be tempting to chase short-term gains or make impulsive investment decisions based on market fluctuations. However, successful wealth accumulation through compound interest requires a long-term perspective and the ability to stay invested even during challenging market conditions. By understanding the role of time in compound interest and having a disciplined approach to investing, you can harness the power of compounding and achieve your financial goals. 3.3.6 The time factor in retirement planning. Retirement planning is an area where the role of time in compound interest is particularly crucial. The earlier you start saving for retirement, the more time your investments have to grow and compound. This can make a significant difference in the size of your retirement nest egg. By starting early and consistently contributing to retirement accounts, such as 401k plans or IRAs, you can take advantage of the power of compound interest over a long investment horizon. This can help ensure a comfortable retirement and provide financial security in your golden years. 3.3.7 Time is an ally in wealth accumulation. Time is your ally when it comes to wealth accumulation through compound interest. The longer you allow your investments to grow, the greater the potential for exponential growth. By starting early, being patient, and staying disciplined, you can harness the power of time and compound interest to build significant wealth over the long term. Remember, time is a limited resource, and the earlier you start investing, the more time you have to benefit from compound interest. So, take advantage of the time you have and start compounding your wealth today. 3.4 The impact of interest rates on compound interest. Interest rates play a crucial role in the world of compound interest. They have a significant impact on the growth and accumulation of wealth over time. In this section, we will explore how interest rates affect compound interest and why it is essential to understand their influence on your financial goals. 3.4.1 Understanding interest rates. Interest rates represent the cost of borrowing money or the return on investment. They are determined by various factors, including the supply and demand for money, inflation rates, and central bank policies. When it comes to compound interest, the interest rate is the percentage at which your investment or debt grows over time. 3.4.2 The effect of interest rates on compound interest. The interest rate directly affects the rate at which your investment or debt compounds. A higher interest rate will lead to faster growth, while a lower interest rate will result in slower growth. Let's explore the impact of interest rates on both investments and debts. 3.4.2.1 Investments. When you invest your money, whether it's in stocks, bonds, or other financial instruments, the interest rate determines the rate at which your investment grows. A higher interest rate means that your investment will accumulate more quickly, leading to higher returns over time. On the other hand, a lower interest rate will result in slower growth and potentially lower returns. For example, let's say you invest $10,000 in a savings account with an annual interest rate of 5%. After 1 year, your investment will grow to $10,500. However, if the interest rate were 10%, your investment would grow to $11,000 in the same time frame. The higher interest rate accelerates the compounding process, allowing your investment to grow at a faster rate. 3.4.2.2 Debts. Interest rates also have a significant impact on debts, such as credit card balances, mortgages, and car loans. When you borrow money, the interest rate determines how much you will owe over time. A higher interest rate means that your debt will accumulate more quickly, leading to higher repayment amounts. Conversely, a lower interest rate will result in slower debt growth and potentially lower repayment amounts. For instance, let's consider a $10,000 credit card balance with an annual interest rate of 20%. If you only make the minimum monthly payments, it will take you much longer to pay off the debt due to the high interest rate. However, if the interest rate were 10%, you would be able to pay off the debt more quickly and with less interest paid overall. 3.4.3 The importance of interest rate comparison. Understanding the impact of interest rates on compound interest highlights the importance of comparing rates before making any financial decisions. Whether you are considering an investment or taking on debt, comparing interest rates can help you make informed choices that align with your financial goals. When it comes to investments, comparing interest rates allows you to identify opportunities that offer higher returns. By choosing investments with higher interest rates, you can maximize the growth potential of your money over time. This is particularly important when considering long-term investments, such as retirement accounts, where even a small difference in interest rates can have a significant impact on your savings. Similarly, when taking on debt, comparing interest rates allows you to find the most favorable terms. By opting for loans or credit cards with lower interest rates, you can minimize the amount of interest you will pay over time. This can save you a substantial amount of money and help you pay off your debts more efficiently. 3.4.4 The role of central banks in interest rates. Central banks, such as the Federal Reserve in the United States or the European Central Bank in Europe, play a crucial role in determining interest rates. They use various monetary policy tools to influence the economy and control inflation. By adjusting interest rates, central banks aim to stimulate or slow down economic growth. When central banks lower interest rates, borrowing becomes cheaper, encouraging individuals and businesses to take on more debt and invest. This can stimulate economic activity and promote growth. Conversely, when central banks raise interest rates, borrowing becomes more expensive, which can slow down economic activity and control inflation. As an investor or borrower, it is essential to keep an eye on central bank decisions and their impact on interest rates. Understanding the broader economic context can help you make informed decisions about your investments and debts. 3.4.5 Balancing Risk and Reward. Interest rates not only impact the growth of your investments or debts but also play a role in balancing risk and reward. Higher interest rates often come with higher risks, as they can be associated with more volatile investments or higher borrowing costs. On the other hand, lower interest rates may offer more stability but potentially lower returns. When considering investments, it is crucial to assess the risk associated with higher interest rates. Higher returns may be attractive, but they often come with increased volatility and the potential for losses. Diversification and a well-balanced portfolio can help mitigate these risks and ensure a more stable long-term investment strategy. Similarly, when taking on debt, it is important to consider the affordability of higher interest rates. While lower interest rates may be more favorable, it is essential to assess your ability to make repayments if rates were to increase in the future. Planning for potential interest rate fluctuations can help you avoid financial stress and ensure that your debt remains manageable. Conclusion. Interest rates have a profound impact on compound interest, influencing the growth of investments and the accumulation of debts. Understanding the relationship between interest rates and compound interest is crucial for making informed financial decisions. By comparing rates, considering risk and reward, and staying informed about central bank policies, you can optimize your financial strategy and maximize the benefits of compound interest. 3.5 Avoiding common mistakes with compound interest. Compound interest is a powerful tool that can help you grow your wealth over time. However, it is important to be aware of common mistakes that people make when it comes to compound interest. By avoiding these mistakes, you can maximize the benefits of compound interest and achieve your financial goals more effectively. 3.5.1 Neglecting to start early. One of the biggest mistakes people make with compound interest is neglecting to start early. The power of compound interest lies in the fact that it allows your money to grow exponentially over time. The longer your money has to compound, the greater the impact it will have on your overall wealth. By starting early, even with small amounts, you give your money more time to grow and take advantage of the compounding effect. Many people make the mistake of thinking that they can start saving or investing later in life and still achieve the same results. However, the reality is that the earlier you start, the more time your money has to work for you. 3.5.2 Failing to consistently contribute. Another common mistake is failing to consistently contribute to your savings or investment accounts. Compound interest works best when you consistently add to your principal amount. By making regular contributions, you increase the base on which the interest is calculated, leading to even greater growth over time. Consistency is key when it comes to compound interest. It is important to set up a systematic approach to saving or investing, whether it's through automatic transfers or regular contributions. By making it a habit to contribute consistently, you ensure that you are taking full advantage of the power of compound interest. 3.5.3 Underestimating the impact of fees. Fees can eat into your compound interest earnings and significantly impact your overall returns. Many investment products and financial services come with fees, such as management fees, transaction fees, and administrative fees. These fees can vary widely and may seem small at first glance, but they can add up over time and erode your compound interest gains. It is crucial to carefully review and understand the fees associated with any investment or financial product you choose. Compare different options and consider the long-term impact of fees on your compound interest growth. By minimizing fees, you can maximize the power of compound interest and keep more of your earnings for yourself. 3.5.4 Ignoring the impact of inflation. Inflation is the gradual increase in the prices of goods and services over time. It erodes the purchasing power of your money. When calculating compound interest, it is important to take into account the impact of inflation. If the interest rate on your investment is lower than the inflation rate, your real returns may be negative. Ignoring the impact of inflation can lead to a false sense of growth. While your investment may be growing in nominal terms, it may not be keeping up with the rising cost of living. It is important to choose investments that have the potential to outpace inflation and preserve your purchasing power over time. 3.5.5 Chasing high-risk investments. While it is important to seek higher returns, it is equally important to assess the risks associated with an investment. Some people make the mistake of chasing high-risk investments in the hope of achieving greater compound interest gains. However, high-risk investments also come with a higher probability of loss. It is crucial to strike a balance between risk and reward when it comes to compound interest. Diversifying your portfolio and considering a mix of low-risk and high-risk investments can help mitigate risk while still allowing for potential growth. It is important to carefully evaluate the risk profile of any investment and ensure it aligns with your financial goals and risk tolerance. 3.5.6 Failing to reinvest dividends or interest. When you receive dividends or interest from your investments, it is important to reinvest them rather than spending them. Reinvesting dividends or interest allows you to take advantage of the compounding effect and accelerate your wealth accumulation. Some people make the mistake of treating dividends or interest as extra income and spend them instead of reinvesting. While it may be tempting to enjoy the immediate benefits of these earnings, reinvesting them can have a significant impact on your long-term wealth. By reinvesting, you increase your principal amount and allow for even greater compound interest growth. 3.5.7 Failing to monitor and adjust. Compound interest is not a set-it-and-forget-it strategy. It requires regular monitoring and adjustments to ensure that you are on track to meet your financial goals. Failing to monitor your investments or savings can lead to missed opportunities or potential losses. It is important to review your investment portfolio regularly and make adjustments as needed. This may involve rebalancing your portfolio, reassessing your risk tolerance, or exploring new investment opportunities. By staying proactive and informed, you can make the necessary adjustments to maximize the benefits of compound interest. 3.5.8 Allowing emotions to drive decisions. Emotional decision-making can be detrimental to your compound interest strategy. Many people make the mistake of letting fear or greed drive their investment decisions. They may panic and sell during market downturns or chase after hot investment trends without proper research. It is important to approach compound interest with a rational and disciplined mindset. Develop a long-term investment plan and stick to it, regardless of short-term market fluctuations. Avoid making impulsive decisions based on emotions and focus on the long-term goals you have set for yourself. By avoiding these common mistakes, you can harness the full potential of compound interest and achieve your financial goals more effectively. Compound interest is a powerful tool, but it requires careful planning, consistency, and a disciplined approach. Stay informed, make informed decisions, and let the power of compound interest work for you. 3.6 Leveraging compound interest for debt management. Debt can be a significant burden for many individuals and families. Whether it's credit card debt, student loans, mortgages, or car loans, the interest on these debts can quickly accumulate and make it challenging to achieve financial stability. However, just as compound interest can work in your favor when it comes to investments and savings, it can also be leveraged to manage and pay off debt more effectively. 3.6.1 Understanding compound interest in debt. Before we delve into leveraging compound interest for debt management, it's crucial to understand how compound interest works in the context of debt. When you borrow money, whether it's from a credit card company or lender, you are typically charged interest on the amount borrowed. This interest is usually calculated based on the outstanding balance and added to the total amount owed. The power of compound interest comes into play when the interest charged on the debt is added to the principal amount, and subsequent interest is calculated based on the new total. This compounding effect can significantly increase the total amount owed over time if the debt is not managed properly. 3.6.2 The snowball method. One popular strategy for leveraging compound interest to manage debt is known as the snowball method. This method involves prioritizing and paying off debts starting with the smallest balance first while making minimum payments on other debts. Once the smallest debt is paid off, the amount that was being paid towards it is then redirected towards the next smallest debt, creating a snowball effect. By focusing on paying off smaller debts first, you can quickly gain momentum and motivation as you see progress being made. As you continue to pay off debts, the amount available to put towards the next debt increases, allowing you to tackle larger debts more aggressively. This method takes advantage of the psychological boost that comes from achieving small victories and can help you stay motivated throughout the debt repayment process. 3.6.3 Debt consolidation. Another way to leverage compound interest for debt management is through debt consolidation. Debt consolidation involves combining multiple debts into a single loan or credit card with a lower interest rate. By consolidating your debts, you can simplify your repayment process and potentially reduce the overall interest you pay. When consolidating debt, it's essential to compare interest rates and terms to ensure that the new loan or credit card offers a lower interest rate than your existing debts. By reducing the interest rate, more of your payments will go towards paying down the principal balance, allowing you to pay off the debt faster. 3.6.4 Making extra payments. Making extra payments towards your debt is another effective way to leverage compound interest for debt management. By paying more than the minimum required payment each month, you can reduce the principal balance faster and ultimately decrease the amount of interest that accrues over time. When making extra payments, it's crucial to communicate with your lender or credit card company to ensure that the additional funds are applied towards the principal balance. Some lenders may automatically apply extra payments towards future interest, which may not have the desired impact on reducing your debt. 3.6.5 Refinancing. Refinancing is a strategy commonly used for mortgages and student loans, but it can also be applied to other types of debt. Refinancing involves replacing an existing loan with a new loan that has more favorable terms, such as a lower interest rate or longer repayment period. By refinancing your debt, you can potentially reduce your monthly payments and the overall interest you pay. This can free up additional funds that can be used to pay down other debts or increase your savings. However, it's important to carefully consider the costs associated with refinancing, such as closing costs or origination fees, to ensure that the benefits outweigh the expenses. 3.6.6 Seeking professional help. If you find yourself overwhelmed with debt and struggling to manage it effectively, seeking professional help may be a wise decision. Credit counseling agencies and debt management companies can provide guidance and assistance in developing a personalized debt management plan. These professionals can negotiate with creditors on your behalf, help you create a budget, and provide education on financial management. They can also offer strategies for leveraging compound interest to manage your debt effectively and provide ongoing support throughout your journey to becoming debt-free. 3.6.7 Staying committed to debt management. Leveraging compound interest for debt management requires discipline, commitment, and a long-term perspective. It's essential to stay focused on your financial goals and make consistent efforts to pay down your debts. By implementing the strategies discussed in this section and staying committed to your debt management plan, you can take control of your financial future and achieve debt-free living. Remember, managing debt is not a quick fix but a journey that requires patience and perseverance. By leveraging compound interest and implementing effective debt management strategies, you can overcome your debts and pave the way for a more secure and prosperous financial future. 4. Compound interest in practice. 4.1 Real-life examples of compound interest. Compound interest is a powerful financial concept that can have a significant impact on your wealth over time. To truly understand its potential, let's explore some real-life examples of compound interest in action. 4.1.1 Investing in the stock market. Imagine you invest $10,000 in the stock market with an average annual return of 8%. If you leave that money untouched for 30 years, the power of compound interest will work its magic. At the end of the 30-year period, your initial investment would have grown to approximately $100,626. This exponential growth is due to the compounding effect of earning interest not only on your initial investment but also on the accumulated interest over time. As the years go by, the interest earned on your investment becomes a larger and larger portion of your total balance, leading to accelerated growth. 4.1.2 Saving for retirement. Let's consider another example, this time focusing on retirement savings. Suppose you start saving $500 per month in a retirement account at the age of 25. Assuming an average annual return of 6%, by the time you reach 65, your retirement account balance would be around $1,044,000. The key here is the long-term nature of compound interest. By starting early and consistently contributing to your retirement savings, you allow your money to grow over several decades. The earlier you start, the more time your investments have to compound, resulting in a larger nest egg for your retirement. 4.1.3 Paying off debt. Compound interest can also work against you when it comes to debt. Credit card debt, for example, often carries high interest rates, which can quickly accumulate over time. Let's say you have a credit card balance of $5,000 with an annual interest rate of 18%. If you only make the minimum monthly payment, it could take you over 20 years to pay off the debt, and you would end up paying a total of $11,616. This example highlights the importance of paying off high-interest debt as soon as possible. By making larger payments and avoiding the minimum payment trap, you can save a significant amount of money in interest charges and free yourself from the burden of debt much sooner. 4.1.4 Real estate investments. Real estate can be another avenue where compound interest can work in your favor. Let's say you purchase a rental property for $200,000 and rent it out for $1,500 per month. After deducting expenses and mortgage payments, you have a net cash flow of $500 per month. Over time, as property values appreciate and rental income increases, your investment can grow significantly. Suppose the property appreciates at an average annual rate of 5% and you hold it for 20 years. At the end of the period, your initial investment of $200,000 could be worth approximately $530,000. This growth is a result of both the rental income and the appreciation of the property value, both of which compound over time. 4.1.5 Starting a business. Compound interest is not limited to traditional investments, it can also apply to entrepreneurial ventures. When starting a business, reinvesting profits back into the company can lead to exponential growth. By reinvesting profits to expand operations, develop new products, or enter new markets, you can compound the growth of your business over time. For example, let's say you start a small online business and reinvest 50% of your profits each year. If your business grows at an average annual rate of 10%, after 10 years, your initial investment could have multiplied several times over. 4.1.6 Education savings. Compound interest can also play a role in saving for your children's education. By starting early and consistently contributing to an education savings account, you can take advantage of the power of compounding to grow your savings over time. This can help alleviate the financial burden of higher education expenses when the time comes. For instance, if you start saving $200 per month in an education savings account with an average annual return of 7%, after 18 years, you could have approximately $85,000 saved for your child's education. These real-life examples demonstrate the incredible potential of compound interest. Whether it's investing in the stock market, saving for retirement, paying off debt, investing in real estate, starting a business, or saving for education, compound interest can be a powerful tool for building wealth and achieving your financial goals. By understanding and harnessing the power of compound interest, you can make informed financial decisions that will have a lasting impact on your financial future. 4.2 Case Studies on Compound Interest. In this section, we will explore several case studies that demonstrate the power of compound interest in real-life scenarios. These examples will help you understand how compound interest can work for you and how it can significantly impact your financial goals. 4.2.1 Case Study 1. Retirement Savings. Let's consider the case of Sarah, who starts saving for retirement at the age of 25. She decides to invest $500 per month in a retirement account with an average annual return of 8%. Sarah plans to retire at the age of 65. By the time Sarah reaches 65, she would have contributed a total of $240,000, $500 per month for 40 years. However, due to the power of compound interest, her retirement account balance would be much higher. Assuming her investments compound annually, her retirement account would grow to approximately $1,615,384. This case study demonstrates the significant impact of compound interest over a long period. By consistently saving and allowing her investments to grow, Sarah was able to accumulate a substantial retirement nest egg. 4.2.2 Case Study 2. College Education Savings. Let's consider the case of Mark and Lisa, who want to save for their child's college education. They start saving when their child is born and plan to contribute $300 per month into a college savings account with an average annual return of 6%. They aim to have enough funds by the time their child turns 18. By the time their child reaches 18, Mark and Lisa would have contributed a total of $64,800, $300 per month for 18 years. However, thanks to the power of compound interest, their college savings account would have grown to approximately $105,000. This case study highlights how compound interest can help parents save for their child's education. By starting early and allowing their savings to compound, Mark and Lisa were able to accumulate a significant amount to support their child's college expenses. 4.2.3 Case Study 3. Debt Repayment. Let's consider the case of John, who has accumulated $10,000 in credit card debt with an interest rate of 18%. John decides to make minimum monthly payments of $200. In this scenario, it would take him approximately 9 years and 8 months to pay off the debt, and he would end up paying a total of $23,600. However, if John decides to increase his monthly payments to $400, he would be able to pay off the debt in just over 3 years and save a significant amount on interest. In this case, he would only pay a total of $12,800, saving $10,800. This case study demonstrates how compound interest can work against you when it comes to debt. By making larger payments and reducing the time it takes to repay the debt, John was able to minimize the impact of compound interest and save a substantial amount of money. 4.2.4 Case Study 4. Long-Term Investment. Let's consider the case of Michael, who decides to invest $10,000 in a diversified portfolio of stocks and bonds. He plans to hold the investment for 30 years and expects an average annual return of 7%. After 30 years, Michael's initial investment of $10,000 would have grown to approximately $76,123. This case study demonstrates the power of compound interest in long-term investments. By staying invested and allowing his money to compound over time, Michael was able to significantly grow his initial investment. 4.2.5 Case Study 5. Real Estate Investment. Let's consider the case of Emily, who decides to invest in real estate. She purchases a property for $200,000 and rents it out. After deducting expenses, Emily receives a net rental income of $1,000 per month. Over time, the value of the property appreciates at an average annual rate of 5%. After 20 years, Emily's property would be worth approximately $530,000, and she would have received a total rental income of $240,000. This case study demonstrates how compound interest can work in real estate investments. By holding the property and benefiting from both rental income and property appreciation, Emily was able to accumulate significant wealth. These case studies illustrate the power of compound interest in various financial scenarios. Whether it's saving for retirement, funding education, managing debt, or making long-term investments, compound interest can play a crucial role in achieving your financial goals. By understanding and harnessing the power of compound interest, you can make informed financial decisions and maximize your wealth accumulation over time. 4.3 Calculating compound interest in different scenarios. Compound interest is a powerful financial concept that allows individuals to grow their wealth exponentially over time. By reinvesting the interest earned on an initial investment, individuals can benefit from the compounding effect, which results in the growth of both the principal amount and the accumulated interest. Understanding how to calculate compound interest in different scenarios is essential for maximizing the potential returns on investments. 4.3.1 Compound Interest Formula. To calculate compound interest, we use a formula that takes into account the principal amount, the interest rate, the compounding period, and the time period. The formula for compound interest is A equals P 1 plus R N caret NT, where A is the future value of the investment loan, including interest. P is the principal amount, the initial investment loan amount. R is the annual interest rate, expressed as a decimal. N is the number of times that interest is compounded per year. T is the number of years the money is invested, borrowed for. 4.3.2 Compound interest calculation examples. Let's explore a few scenarios to understand how compound interest works in practice. Example 1. Saving for retirement. Suppose you want to save for retirement and decide to invest $10,000 in a retirement account that offers an annual interest rate of 6%. The interest is compounded annually, and you plan to leave the money invested for 30 years. Using the compound interest formula, we can calculate the future value of your investment. A equals 10000, 1 plus 0.06, 1 carat 1 asterisk 30. A equals 10000, 1 plus 0.06 carat 30. A equals 10000, 1.06 carat 30. A approximately equals $57,434.25. After 30 years, your initial investment of $10,000 will grow to approximately $57,434.25. This demonstrates the power of compound interest over a long time horizon. Example 2. Investing in stocks. Let's consider another scenario where you invest $5,000 in a stock that has an average annual return of 8%. The interest is compounded semi-annually, and you plan to hold the investment for 5 years. Using the compound interest formula, we can calculate the future value of your investment. A equals 5,000, 1 plus 0.08, 2 carat 2 asterisk 5. A equals 5,000, 1 plus 0.04 carat 10. A approximately equals $7,122.97. After 5 years, your initial investment of $5,000 will grow to approximately $7,122.97. This example highlights how compound interest can help grow your investments in the stock market. Example 3. Paying off a loan. Compound interest is not only applicable to investments but also to loans. Let's say you borrow $20,000 at an annual interest rate of 5% for a period of 3 years. The interest is compounded monthly. Using the compound interest formula, we can calculate the total amount you will have to repay. A equals 20000, 1 plus 0.05, 12 carat 12 asterisk 3. A equals 20000, 1 plus 0.00417 carat 36. A approximately equals $22,093.94. After 3 years, you will have to repay a total of approximately $22,093.94, including both the principal amount and the accumulated interest. This example demonstrates how compound interest affects the total repayment amount for loans. 4.3.3 Factors affecting compound interest. Several factors can influence the growth of compound interest in different scenarios. 4.3.3.1 Interest rate. The interest rate plays a crucial role in determining the growth of compound interest. Higher interest rates result in faster growth, while lower interest rates lead to slower growth. It is essential to consider the interest rate when making investment or borrowing decisions. 4.3.3.2 Compounding period. The compounding period refers to how often the interest is calculated and added to the principal amount. The more frequent the compounding, the faster the growth of compound interest. Common compounding periods include annually, semi-annually, quarterly, monthly, and daily. 4.3.3.3 Time period. The time period for which the money is invested or borrowed significantly impacts the growth of compound interest. The longer the time period, the greater the potential for exponential growth. Starting early and allowing the power of compounding to work over a more extended period can lead to substantial wealth accumulation. 4.3.4 Using compound interest calculations. Understanding how to calculate compound interest in different scenarios empowers individuals to make informed financial decisions. Whether it's saving for retirement, investing in stocks, or managing loans, compound interest calculations provide valuable insights into the potential growth or repayment amounts. By utilizing the compound interest formula and considering factors such as interest rates, compounding periods, and time periods, individuals can assess the potential returns on investments or the total repayment amounts for loans. This knowledge enables individuals to plan their financial goals effectively and make informed decisions to compound their wealth over time. In the next chapter, we will explore how compound interest applies to various investment vehicles, including stocks, bonds, mutual funds, and real estate investments. Understanding the relationship between compound interest and different investment options will further enhance your ability to grow your wealth. 4.4 Using compound interest to reach financial goals. Compound interest is a powerful tool that can help individuals achieve their financial goals. By understanding how compound interest works and implementing strategies to maximize its benefits, individuals can effectively grow their wealth over time. In this section, we will explore how compound interest can be used to reach various financial goals. 4.4.1 Saving for short-term goals. Compound interest can be utilized to save for short-term financial goals, such as purchasing a car, going on a vacation, or making a down payment on a house. The key is to start saving early and consistently contribute to your savings account. By depositing money into an account that earns compound interest, you can watch your savings grow over time. For example, let's say you want to save $10,000 for a down payment on a house in 5 years. By calculating the amount you need to save each month and finding an account that offers compound interest, you can determine how much you need to contribute regularly to reach your goal. The longer you save and the higher the interest rate, the faster your savings will grow. 4.4.2 Building an emergency fund. An emergency fund is an essential component of a solid financial plan. It provides a safety net for unexpected expenses, such as medical bills, car repairs, or job loss. Compound interest can help you build an emergency fund more quickly. By setting aside a portion of your income each month and depositing it into a high-yield savings account that earns compound interest, you can watch your emergency fund grow over time. The interest earned on your savings will compound, allowing your emergency fund to grow even faster. 4.4.3 Saving for retirement. One of the most common long-term financial goals is saving for retirement. Compound interest plays a crucial role in helping individuals accumulate a substantial retirement nest egg. The earlier you start saving for retirement, the more time your money has to grow through the power of compound interest. By contributing regularly to retirement accounts such as a 401k or an individual retirement account, IRA, you can take advantage of compound interest over several decades. The compounding effect allows your contributions to grow exponentially, helping you build a significant retirement fund. 4.4.4 Paying off debt. Compound interest can also be used to accelerate the process of paying off debt. Whether it's credit card debt, student loans, or a mortgage, compound interest can work in your favor when used strategically. By making extra payments towards your debt, you can reduce the principal balance faster. This, in turn, reduces the amount of interest that accrues over time. By consistently making extra payments, you can save a significant amount of money on interest and pay off your debt sooner. 4.4.5 Investing for long-term growth. Compound interest is a fundamental principle in long-term investing. By investing in assets such as stocks, bonds, mutual funds, or real estate, you can take advantage of the compounding effect to grow your investments over time. The key to using compound interest for long-term growth is to start investing early and remain consistent. By reinvesting dividends or interest earned, you can accelerate the growth of your investments. Over time, the compounding effect can lead to substantial wealth accumulation. 4.4.6 Setting realistic goals. When using compound interest to reach financial goals, it is essential to set realistic and achievable targets. Consider factors such as your current financial situation, time horizon, risk tolerance, and desired outcome. Setting specific, measurable, attainable, relevant, and time-bound, SMART goals will help you stay focused and motivated. Remember that compound interest is a long-term strategy, and it requires patience and discipline. It may take time to see significant growth, but the power of compounding can lead to substantial results over the years. 4.4.7 Monitoring and adjusting your plan. As you work towards your financial goals using compound interest, it is crucial to regularly monitor and adjust your plan. Review your progress periodically and make any necessary adjustments to stay on track. Life circumstances and financial markets can change, so it's essential to reassess your goals and adjust your contributions or investment strategy accordingly. By staying proactive and making informed decisions, you can maximize the benefits of compound interest and increase your chances of reaching your financial goals. In conclusion, compound interest is a valuable tool that can help individuals reach their financial goals. Whether it's saving for short-term needs, building an emergency fund, saving for retirement, paying off debt, or investing for long-term growth, compound interest can be utilized effectively. By understanding the principles of compound interest and implementing a well-thought-out plan, individuals can harness the power of compounding to achieve financial success. 5. Compound interest and investments. 5.1 Compound interest in stocks. Investing in stocks is one of the most popular ways to grow wealth and take advantage of compound interest. Stocks represent ownership in a company and can provide significant returns over time. When combined with the power of compound interest, investing in stocks can lead to substantial wealth accumulation. The basics of stock investing. Before delving into the relationship between compound interest and stocks, it is important to understand the basics of stock investing. When you buy shares of a company's stock, you become a partial owner of that company. As the company grows and becomes more profitable, the value of your shares can increase. Stocks are typically classified into two categories: growth stocks and dividend stocks. Growth stocks are shares of companies that are expected to experience significant growth in the future. These companies reinvest their profits back into the business to fuel expansion and innovation. On the other hand, dividend stocks are shares of companies that distribute a portion of their profits to shareholders in the form of dividends. Compound interest and stock returns. Compound interest plays a crucial role in maximizing the returns from stock investments. When you invest in stocks, you have the opportunity to earn both capital gains and dividends. Capital gains refer to the increase in the value of your stocks over time, while dividends are the periodic payments made by companies to their shareholders. By reinvesting the dividends received from stocks, you can take advantage of compound interest. Instead of spending the dividends, you can use them to purchase additional shares of the same stock or different stocks. This process is known as dividend reinvestment, and it allows you to compound your returns over time. For example, let's say you invest $10,000 in a stock that pays an annual dividend yield of 3%. In the first year, you would receive $300 in dividends. Instead of spending this money, you reinvest it by purchasing more shares of the same stock. In the second year, your investment would grow to $10,300, and you would receive $309 in dividends. By reinvesting the dividends each year, your investment would continue to grow exponentially, taking advantage of compound interest. Long-term investing and compound interest. One of the key principles of compound interest is the importance of time. The longer you stay invested in the stock market, the more time your investments have to grow and compound. This is why long-term investing is often recommended for those looking to maximize their returns. Historically, the stock market has delivered positive returns over the long term, despite short-term fluctuations. By staying invested for an extended period, you can ride out market volatility and benefit from the compounding effect of your investments. Diversification and risk management. While investing in stocks can be lucrative, it is important to remember that it also carries risks. Stock prices can be volatile, and individual companies can face financial difficulties or even go bankrupt. To mitigate these risks, diversification is key. Diversification involves spreading your investments across different stocks, industries, and asset classes. By diversifying your portfolio, you reduce the impact of any single investment on your overall returns. This helps to protect your investments from the potential downfall of a single stock or sector. Additionally, it is important to conduct thorough research and analysis before investing in individual stocks. Understanding the financial health, competitive position, and growth prospects of the companies you invest in can help you make informed investment decisions and manage risk effectively. Conclusion. Investing in stocks can be a powerful way to grow wealth, especially when combined with the concept of compound interest. By reinvesting dividends and staying invested for the long term, you can take advantage of the compounding effect and potentially achieve significant returns. However, it is crucial to approach stock investing with caution and to diversify your portfolio to manage risk effectively. Conducting thorough research and seeking professional advice can help you make informed investment decisions and maximize the benefits of compound interest in the stock market. 5.2 Compound interest in bonds. Bonds are a popular investment option for individuals looking to generate income and preserve capital. They are considered a relatively safe investment compared to stocks, making them an attractive choice for conservative investors. In this section, we will explore the relationship between compound interest and bonds, and how they can work together to help grow your wealth. 5.2.1 Understanding bonds. Before delving into the connection between compound interest and bonds, it is essential to have a clear understanding of what bonds are. Bonds are debt instruments issued by governments, municipalities, and corporations to raise capital. When you invest in a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the return of the principal amount at maturity. Bonds have a predetermined interest rate, known as the coupon rate, which is typically paid semi-annually or annually. The interest payments remain fixed throughout the life of the bond, providing investors with a predictable income stream. The principal amount, or face value, is returned to the bondholder upon maturity. 5.2.2 Compound interest and bond investing. Compound interest plays a significant role in bond investing, as it allows investors to earn interest not only on the initial investment but also on the accumulated interest over time. This compounding effect can significantly enhance the overall return on investment. Let's consider an example to illustrate the power of compound interest in bond investing. Suppose you invest $10,000 in a bond with a coupon rate of 5% and a maturity period of 10 years. The bond pays interest annually. In the first year, you would receive $500 in interest, 5% of $10,000. However, in the second year, you would earn interest not only on the initial $10,000 but also on the $500 interest earned in the first year. This compounding effect continues throughout the life of the bond. As a result, the total amount of interest earned over the 10-year period would be higher than if the interest were not compounded. The longer the bond's maturity period, the greater the impact of compound interest on the overall return. 5.2.3 Reinvesting bond interest. One way to maximize the benefits of compound interest when investing in bonds is to reinvest the interest payments. Instead of spending the interest income, you can reinvest it back into additional bonds or other investment vehicles. By reinvesting the interest, you allow it to compound over time, leading to exponential growth in your investment portfolio. Reinvesting bond interest can be done in various ways. One option is to purchase additional bonds with the interest income received. This approach allows you to increase the size of your bond portfolio and generate even more interest income. Another option is to invest the interest in other investment vehicles, such as stocks or mutual funds, to diversify your portfolio and potentially earn higher returns. 5.2.4 Bond laddering strategy. Another strategy that combines compound interest and bond investing is the bond laddering strategy. This approach involves purchasing bonds with staggered maturities to create a steady stream of income while taking advantage of higher interest rates. With the bond laddering strategy, you divide your investment into multiple bonds with different maturity dates. For example, you might invest in bonds with maturities of 1 year, 3 years, 5 years, and 10 years. As each bond matures, you reinvest the principal amount into a new bond with the longest remaining maturity. This strategy allows you to benefit from higher interest rates that may be available in the future while maintaining a consistent income stream. By utilizing the bond laddering strategy, you can take advantage of compound interest by reinvesting the principal amount at regular intervals. This approach helps to mitigate the impact of interest rate fluctuations and provides a more stable income stream over time. 5.2.5 Risks and Considerations. While compound interest can be a powerful tool when investing in bonds, it is essential to consider the risks associated with bond investing. Bonds are not entirely risk-free, and their value can fluctuate based on changes in interest rates and the creditworthiness of the issuer. Interest rate risk is a significant concern for bond investors. When interest rates rise, the value of existing bonds decreases, as newer bonds with higher interest rates become more attractive. This can result in a decline in the market value of your bond investments. However, if you hold the bond until maturity, you will still receive the full principal amount. Credit risk is another consideration when investing in bonds. It refers to the likelihood of the issuer defaulting on its debt obligations. Bonds issued by governments or highly rated corporations are generally considered safer, while bonds issued by lower-rated entities carry a higher risk of default. It is crucial to assess the creditworthiness of the issuer before investing in their bonds. In conclusion, compound interest can significantly enhance the returns on bond investments. By reinvesting interest income and utilizing strategies like bond laddering, investors can take advantage of the compounding effect to grow their wealth over time. However, it is essential to consider the risks associated with bond investing and conduct thorough research before making any investment decisions. 5.3 Compound Interest and Mutual Funds. Mutual funds are a popular investment option for individuals looking to grow their wealth through compound interest. These investment vehicles pool money from multiple investors and are managed by professional fund managers. Mutual funds offer a diversified portfolio of stocks, bonds, and other securities, allowing investors to benefit from the power of compound interest while minimizing risk. 5.3.1 Understanding mutual funds. Before delving into the relationship between compound interest and mutual funds, it is important to understand the basics of mutual funds. A mutual fund is a type of investment vehicle that pools money from multiple investors to invest in a diversified portfolio of securities. These securities can include stocks, bonds, money market instruments, and other assets. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. These managers aim to generate returns by investing in a variety of assets that align with the fund's investment objectives. Investors can choose from a wide range of mutual funds, each with its own investment strategy and risk profile. 5.3.2 Compound Interest and Mutual Funds. Compound interest plays a significant role in the growth of investments in mutual funds. As investors contribute money to a mutual fund, their investment earns returns in the form of dividends, interest, or capital gains. These returns are reinvested back into the fund, leading to the compounding effect. The compounding effect occurs when the returns generated by an investment are reinvested, allowing the investment to grow exponentially over time. In the case of mutual funds, the returns earned by the fund are reinvested in additional shares of the fund, increasing the overall value of the investment. The power of compound interest in mutual funds can be seen over long-term investment horizons. As the investment grows, the compounding effect becomes more pronounced, leading to accelerated growth. This is particularly beneficial for individuals who have a long-term investment horizon, such as those saving for retirement or other long-term financial goals. 5.3.3 Benefits of investing in mutual funds. Investing in mutual funds offers several benefits when it comes to compound interest. Diversification. One of the key advantages of mutual funds is their ability to provide diversification. By investing in a mutual fund, investors gain exposure to a diversified portfolio of securities. This diversification helps to spread risk and reduce the impact of any individual investment's performance on the overall portfolio. Diversification is crucial for long-term wealth accumulation and can help mitigate the impact of market volatility. Professional management. Mutual funds are managed by experienced professionals who have expertise in analyzing and selecting investments. These fund managers conduct thorough research and analysis to identify investment opportunities that align with the fund's objectives. Their expertise can help investors navigate the complexities of the financial markets and make informed investment decisions. Liquidity. Mutual funds offer liquidity, allowing investors to buy or sell their shares on any business day. This liquidity provides flexibility and convenience, enabling investors to access their funds when needed. The ability to easily buy or sell shares ensures that investors can take advantage of market opportunities or meet their financial needs without facing significant barriers. Cost efficiency. Investing in mutual funds can be cost-effective compared to investing in individual securities. Mutual funds pool money from multiple investors, allowing for economies of scale in transaction costs and management fees. Additionally, mutual funds often have lower minimum investment requirements, making them accessible to a wide range of investors. 5.3.4 Considerations for investing in mutual funds. While mutual funds offer numerous benefits, it is important for investors to consider certain factors before investing. Investment objectives and risk tolerance. Investors should align their investment objectives and risk tolerance with the mutual fund's investment strategy. Different mutual funds have varying levels of risk and return potential. It is crucial to assess one's risk tolerance and investment goals to select a mutual fund that aligns with their financial objectives. Fees and expenses. Mutual funds charge fees and expenses, which can impact investment returns. Investors should carefully review the fund's prospectus to understand the fees associated with the investment. Common fees include management fees, sales loads, and redemption fees. Evaluating the fees and expenses is essential to ensure that the potential returns outweigh the costs. Performance and track record. Investors should evaluate the historical performance and track record of a mutual fund before investing. While past performance does not guarantee future results, it can provide insights into the fund's ability to generate returns. Investors should consider factors such as the fund's performance relative to its benchmark and its consistency over different market cycles. Fund management. The expertise and track record of the fund manager are crucial considerations. Investors should research the fund manager's experience, investment philosophy, and performance history. A skilled and experienced fund manager can significantly impact the fund's performance and the investor's overall returns. 5.3.5 Conclusion. Mutual funds provide investors with an opportunity to benefit from the power of compound interest. By investing in a diversified portfolio of securities, investors can harness the compounding effect and potentially achieve long-term wealth accumulation. However, it is important for investors to carefully evaluate their investment objectives, risk tolerance, fees, and the track record of the fund before making investment decisions. With proper due diligence and a long-term perspective, mutual funds can be a valuable tool for compounding wealth. 5.4 Compound interest and real estate investments. Real estate investments have long been considered a lucrative avenue for wealth accumulation and preservation. When combined with the power of compound interest, real estate investments can provide significant returns over time. In this section, we will explore how compound interest can be applied to real estate investments and the benefits it can offer to investors. 5.4.1 Real estate is a long-term investment. Real estate investments are typically seen as long-term investments, and this aligns perfectly with the principles of compound interest. The longer you hold onto a real estate investment, the more time it has to appreciate in value and generate income. This appreciation and income can then be reinvested, allowing compound interest to work its magic. 5.4.2 Appreciation and compound interest. One of the key ways real estate investments generate returns is through property appreciation. Over time, real estate properties tend to increase in value due to various factors such as market demand, location, and improvements made to the property. When you hold onto a property for an extended period, the appreciation can compound, leading to substantial gains. For example, let's say you purchase a property for $200,000 and it appreciates at an average annual rate of 5%. After 10 years, the property would be worth approximately $325,778. If you decide to sell the property at that point, you would have earned a profit of $125,778. However, if you reinvest that profit into another property, the compound interest effect continues to grow your wealth. 5.4.3 Rental income and compound interest. Another way real estate investments can benefit from compound interest is through rental income. When you own a rental property, you receive regular rental payments from tenants. This income can be reinvested to purchase additional properties or pay down existing mortgages, allowing you to leverage the power of compound interest. Let's consider an example. Suppose you own a rental property that generates $2,000 in monthly rental income. After deducting expenses such as property taxes, maintenance, and mortgage payments, you have a net rental income of $1,500 per month. If you reinvest this income into another property or use it to pay down the mortgage on your existing property, you can accelerate the growth of your real estate portfolio through compound interest. 5.4.4 Leveraging real estate investments. One of the unique advantages of real estate investments is the ability to leverage your capital. By using borrowed funds, such as a mortgage, you can acquire properties with a smaller initial investment. This leverage amplifies the potential returns and allows you to benefit even more from compound interest. For instance, let's say you purchase a property worth $500,000 with a down payment of $100,000 and finance the remaining $400,000 through a mortgage. If the property appreciates at a rate of 5% per year, your initial investment of $100,000 would grow to approximately $162,889 after 10 years. This represents a compounded return on investment of over 62%. Without the leverage provided by the mortgage, your return would have been significantly lower. 5.4.5 Tax advantages of real estate investments. Real estate investments also offer various tax advantages that can further enhance the benefits of compound interest. For example, rental income is often taxed at a lower rate compared to ordinary income. Additionally, expenses related to property maintenance, repairs, and mortgage interest can be deducted from your taxable income. These tax benefits can help you retain more of your investment returns, allowing compound interest to work its magic on a larger portion of your wealth. 5.4.6 Diversification and risk management. Investing in real estate can also provide diversification benefits to your investment portfolio. Real estate has historically exhibited a low correlation with other asset classes such as stocks and bonds. By including real estate investments in your portfolio, you can reduce overall portfolio risk and potentially enhance returns through diversification. Furthermore, real estate investments can act as a hedge against inflation. As the value of properties tends to rise with inflation, owning real estate can help preserve your purchasing power over time. This inflation protection, combined with the compounding effect of interest, can contribute to long-term wealth accumulation and preservation. 5.4.7 Risks and Considerations. While real estate investments offer numerous advantages when it comes to compound interest, it is essential to consider the risks involved. Real estate markets can be subject to fluctuations, and property values may not always appreciate as expected. Additionally, managing rental properties can require time, effort, and expertise. It is crucial to conduct thorough research, due diligence, and risk assessment before investing in real estate. Consider factors such as location, market conditions, rental demand, and potential risks. Diversifying your real estate portfolio across different properties and locations can also help mitigate risks and maximize the benefits of compound interest. Conclusion. Real estate investments can be an excellent vehicle for harnessing the power of compound interest. By holding onto properties for the long term, benefiting from appreciation and rental income, leveraging your capital, and taking advantage of tax benefits, you can compound your wealth over time. However, it is essential to carefully evaluate the risks and consider diversification strategies to ensure a successful real estate investment journey. 6. Compound interest and savings accounts. 6.1 Compound interest and traditional savings accounts. Compound interest is a powerful financial concept that can greatly impact your savings and investments over time. In this section, we will explore how compound interest applies to traditional savings accounts and the potential benefits it offers. Understanding compound interest in savings accounts. A traditional savings account is a common financial tool that allows individuals to deposit money and earn interest on their savings. The interest earned on a savings account can be calculated using the principle of compound interest. Compound interest is the process of earning interest on both the initial amount deposited, known as the principal, and any interest that has already been earned. Unlike simple interest, which is calculated only on the principal amount, compound interest allows your savings to grow exponentially over time. The power of compound interest in savings accounts. Compound interest has the potential to significantly boost your savings over the long term. The key to maximizing the benefits of compound interest is to start saving early and consistently contribute to your savings account. Let's consider an example to illustrate the power of compound interest. Suppose you deposit $1,000 into a traditional savings account that offers an annual interest rate of 5%. At the end of the first year, you would earn $50 in interest, bringing your total savings to $1,050. In the second year, however, you would earn interest not only on your initial $1,000 but also on the $50 interest earned in the first year. Assuming you don't make any additional deposits, your interest for the second year would be $52.50, bringing your total savings to $1,102.50. As you can see, the interest earned in each subsequent year continues to compound, resulting in a higher return on your savings. Over time, this compounding effect can lead to significant growth in your savings account. The role of time in compound interest. One of the critical factors in maximizing the benefits of compound interest is time. The longer your money remains invested, the more time it has to grow through the power of compounding. By starting to save early and allowing your savings to compound over several years or even decades, you can harness the full potential of compound interest. Even small contributions made consistently over time can accumulate into a substantial sum due to the compounding effect. Interest rates and compound interest in savings accounts. The interest rate offered by your savings account plays a crucial role in determining the growth of your savings through compound interest. A higher interest rate means that your savings will grow at a faster rate, while a lower interest rate will result in slower growth. When choosing a traditional savings account, it is essential to consider the interest rate being offered. While interest rates can vary between financial institutions, it is generally advisable to seek out accounts that offer competitive rates to maximize the benefits of compound interest. The impact of compounding periods on savings accounts. In addition to the interest rate, the frequency at which interest is compounded can also affect the growth of your savings. Compounding can occur annually, semi-annually, quarterly, monthly, or even daily, depending on the terms of your savings account. The more frequently interest is compounded, the faster your savings will grow. For example, if your savings account compounds interest monthly, you will earn more interest over the course of a year compared to an account that compounds interest annually. When comparing savings accounts, it is essential to consider both the interest rate and the compounding frequency to determine which account will provide the most significant growth potential for your savings. The importance of regular contributions. While compound interest can work wonders for your savings, it is crucial to remember that regular contributions are equally important. By consistently adding to your savings account, you can accelerate the growth of your savings and take full advantage of compound interest. Regular contributions allow you to increase the principal amount, which, in turn, leads to higher interest earnings. The more you contribute, the more your savings will compound, resulting in even greater growth over time. Balancing risk and return. When considering traditional savings accounts, it is essential to understand that they typically offer lower interest rates compared to other investment options. While savings accounts provide a safe and secure way to grow your money, the returns may not be as high as those offered by riskier investments. It is crucial to strike a balance between risk and return when deciding how much of your savings to allocate to a traditional savings account. While the stability and accessibility of savings accounts make them an attractive option, it may be beneficial to explore other investment avenues to achieve higher returns over the long term. Conclusion. Compound interest can be a valuable tool for growing your savings in a traditional savings account. By understanding how compound interest works and the factors that influence its growth, you can make informed decisions about your savings strategy. Remember, the key to maximizing the benefits of compound interest is to start saving early, contribute regularly, and choose a savings account with competitive interest rates and frequent compounding periods. By harnessing the power of compound interest, you can set yourself on a path to financial security and achieve your long-term savings goals. 6.2 Compound interest and high-yield savings accounts. High-yield savings accounts are a popular financial tool that can help individuals maximize the power of compound interest. In this section, we will explore how high-yield savings accounts work, their benefits, and how they can be used to compound wealth over time. 6.2.1 Understanding high-yield savings accounts. A high-yield savings account is a type of savings account that offers a higher interest rate compared to traditional savings accounts. These accounts are typically offered by online banks or credit unions and provide individuals with an opportunity to earn more on their savings. The interest rates offered by high-yield savings accounts are often significantly higher than those offered by traditional savings accounts. This means that individuals can earn more interest on their savings, allowing their money to grow at a faster rate. 6.2.2 The power of compound interest in high-yield savings accounts. Compound interest is a powerful concept that allows individuals to earn interest not only on their initial deposit but also on the accumulated interest over time. This means that as interest is added to the account, it begins to earn interest itself, leading to exponential growth. High-yield savings accounts are particularly advantageous when it comes to compounding interest. With their higher interest rates, individuals can see their savings grow at an accelerated pace. The more frequently interest is compounded, the faster the savings will grow. 6.2.3 Benefits of high-yield savings accounts. There are several benefits to utilizing high-yield savings accounts to compound wealth. 1. Higher interest rates. The primary advantage of high-yield savings accounts is the higher interest rates they offer. By earning more interest on your savings, you can accelerate the growth of your wealth over time. 2. Safety and security. High-yield savings accounts are typically offered by reputable financial institutions, ensuring the safety and security of your funds. These accounts are often insured by the Federal Deposit Insurance Corporation (FDIC) or the National Credit Union Administration (NCUA), providing added peace of mind. 3. Accessibility. High-yield savings accounts are easily accessible, allowing individuals to deposit and withdraw funds as needed. This flexibility makes them a convenient option for both short-term and long-term savings goals. 4. No investment risk. Unlike other investment options, high-yield savings accounts do not carry any investment risk. The principal amount deposited in the account is not subject to market fluctuations, making it a low-risk option for individuals who prefer stability. 6.2.4 Strategies for maximizing compound interest in high-yield savings accounts. To make the most of a high-yield savings account and maximize compound interest, consider the following strategies. 1. Regular contributions. Consistently adding funds to your high-yield savings account allows you to take advantage of compound interest. By making regular contributions, you increase the principal amount, which in turn leads to higher interest earnings. 2. Automatic transfers. Setting up automatic transfers from your checking account to your high-yield savings account ensures that you consistently save and contribute to your savings. This eliminates the risk of forgetting to make deposits and helps you stay on track with your financial goals. 3. Reinvesting interest. Rather than withdrawing the interest earned, consider reinvesting it back into the high-yield savings account. By doing so, you allow the interest to compound and generate even more interest over time. 4. Comparing rates. It is essential to compare the interest rates offered by different high-yield savings accounts. Different financial institutions may offer varying rates, so it is wise to choose an account that provides the highest rate possible. This will maximize your earnings and the power of compound interest. 6.2.5 Considerations and limitations. While high-yield savings accounts offer numerous benefits, it is important to be aware of their limitations and consider other investment options as well. Some considerations include: 1. Inflation risk. High-yield savings accounts may not always keep up with inflation rates. If the interest earned is lower than the inflation rate, the purchasing power of your savings may decrease over time. 2. Opportunity cost. While high-yield savings accounts provide a safe and secure way to grow your savings, they may not offer the same potential returns as other investment options such as stocks or real estate. It is important to consider your financial goals and risk tolerance when deciding where to allocate your funds. 3. Withdrawal restrictions. Some high-yield savings accounts may have withdrawal restrictions or penalties for early withdrawals. It is important to understand these terms and conditions before opening an account to ensure they align with your financial needs. In conclusion, high-yield savings accounts can be a valuable tool for compounding wealth through the power of compound interest. By taking advantage of their higher interest rates and implementing effective strategies, individuals can accelerate the growth of their savings over time. However, it is important to consider the limitations and explore other investment options to ensure a well-rounded financial plan. 6.3 Compound Interest and Certificates of Deposit (CDs). Certificates of deposit (CDs) are a popular investment option for individuals looking to earn a fixed rate of return on their savings over a specific period of time. CDs offer a secure and low-risk investment opportunity, making them an attractive choice for conservative investors who prioritize capital preservation. 6.3.1 What are certificates of deposit (CDs)? Certificates of deposit, commonly referred to as CDs, are financial instruments offered by banks and credit unions. They are a type of time deposit where individuals deposit a specific amount of money for a fixed period of time, known as the term or maturity period. During this time, the deposited funds earn interest at a predetermined rate, which is typically higher than that of a traditional savings account. CDs are considered low-risk investments because they are insured by the Federal Deposit Insurance Corporation (FDIC) in the United States, up to the maximum limit allowed by law. This insurance provides investors with peace of mind, knowing that even if the bank fails, their principal investment will be protected. 6.3.2 How do certificates of deposit (CDs) work? When you invest in a CD, you agree to keep your money deposited with the bank for a specific period of time, known as the term or maturity period. The term can range from a few months to several years, depending on the CD's terms and conditions. During this time, you cannot withdraw the funds without incurring a penalty, which is typically a percentage of the interest earned or a set number of months' worth of interest. The interest rate on a CD is fixed for the entire term, meaning it will not change regardless of any fluctuations in the market. This fixed rate is one of the main advantages of CDs, as it provides investors with a predictable and guaranteed return on their investment. At the end of the term, the CD reaches its maturity date. At this point, you have the option to withdraw the principal amount along with the accumulated interest, or you can choose to reinvest the funds into another CD. If you do not take any action, some banks may automatically renew the CD for another term. 6.3.3 Benefits of investing in certificates of deposit (CDs). 6.3.3.1 Safety and security. One of the primary benefits of investing in CDs is the safety and security they offer. As mentioned earlier, CDs are insured by the FDIC, providing protection for your principal investment. This makes them an attractive option for risk-averse investors who prioritize capital preservation. 6.3.3.2 Fixed and guaranteed returns. CDs provide investors with a fixed and guaranteed rate of return for the entire term. This means that regardless of any market fluctuations or changes in interest rates, you will receive the agreed-upon interest rate until the CD matures. This predictability makes CDs an appealing choice for individuals who prefer a stable and reliable source of income. 6.3.3.3 Diversification. Investing in CDs can be a valuable component of a diversified investment portfolio. By allocating a portion of your savings to CDs, you can balance out the riskier investments in your portfolio, such as stocks or mutual funds. CDs provide stability and act as a hedge against market volatility, helping to protect your overall investment portfolio. 6.3.3.4 Flexibility in terms. CDs offer a range of terms to choose from, allowing investors to select the duration that best suits their financial goals. Whether you are saving for a short-term goal, such as a vacation, or a long-term goal, such as retirement, there is likely a CD term that aligns with your specific needs. This flexibility allows you to tailor your investment strategy to meet your individual financial objectives. 6.3.4 Considerations for investing in certificates of deposit (CDs). While CDs offer several advantages, there are a few considerations to keep in mind before investing. 6.3.4.1 Lower returns compared to other investments. Although CDs provide a guaranteed rate of return, the interest rates offered are typically lower compared to other investment options, such as stocks or mutual funds. This is because CDs are considered low-risk investments. If your primary goal is to maximize your returns, you may need to explore other investment avenues. 6.3.4.2 Limited liquidity. When you invest in a CD, your funds are locked in for the duration of the term. If you anticipate needing access to your money before the CD matures, you may face penalties for early withdrawal. It is essential to carefully consider your financial needs and ensure that you have sufficient emergency funds available before investing in CDs. 6.3.4.3 Inflation risk. CDs may not provide adequate protection against inflation. If the rate of inflation exceeds the interest rate earned on the CD, the purchasing power of your money may decrease over time. It is important to assess the potential impact of inflation on your investment returns and consider other investment options that may offer better protection against inflation. 6.3.5 Conclusion. Certificates of deposit (CDs) are a secure and low-risk investment option that can provide individuals with a fixed and guaranteed rate of return. They offer safety, stability, and flexibility in terms, making them an attractive choice for conservative investors looking to preserve their capital and earn a predictable income. However, it is important to consider the lower returns, limited liquidity, and potential inflation risk associated with CDs before making investment decisions. By understanding the features and considerations of CDs, you can determine if they align with your financial goals and risk tolerance. 6.4 Compound interest and money market accounts. Money market accounts are a popular choice for individuals looking to earn interest on their savings while maintaining easy access to their funds. These accounts offer a combination of safety, liquidity, and competitive interest rates, making them an attractive option for those seeking to grow their wealth through compound interest. 6.4.1 Understanding money market accounts. A money market account is a type of savings account offered by banks and credit unions. It is similar to a traditional savings account but typically offers higher interest rates. Money market accounts are considered low-risk investments because they are insured by the Federal Deposit Insurance Corporation (FDIC) up to the maximum limit allowed by law. Money market accounts are designed to provide a safe place for individuals to park their cash and earn interest. They are often used as a short-term investment vehicle or as an alternative to a traditional savings account. These accounts typically require a higher minimum balance than regular savings accounts and may have limitations on the number of withdrawals or transfers allowed per month. 6.4.2 Compound interest and money market accounts. Compound interest plays a significant role in the growth of money market accounts. Unlike simple interest, which is calculated only on the initial principal amount, compound interest takes into account the accumulated interest over time. This means that the interest earned in one period is added to the principal, and subsequent interest is calculated based on the new total. Money market accounts typically compound interest on a daily or monthly basis, depending on the financial institution. The more frequently interest is compounded, the faster the account balance will grow. This compounding effect allows individuals to earn interest not only on their initial deposit but also on the interest earned over time. For example, let's say you deposit $10,000 into a money market account with an annual interest rate of 2%. If the interest is compounded monthly, at the end of the first month, you would earn $16.67 in interest. The following month, the interest would be calculated based on the new balance of $10,016.67, resulting in slightly higher interest earnings. Over time, this compounding effect can significantly boost the overall return on your investment. 6.4.3 Benefits of money market accounts. Money market accounts offer several benefits that make them an attractive option for individuals looking to grow their savings through compound interest. 1. Safety and security. Money market accounts are considered low-risk investments because they are insured by the FDIC. This means that even if the financial institution fails, your deposits are protected up to the maximum limit allowed by law. This level of safety and security provides peace of mind to account holders. 2. Liquidity. Money market accounts offer a high level of liquidity, allowing individuals to access their funds easily. Unlike other investment options that may have restrictions or penalties for early withdrawals, money market accounts typically allow a certain number of withdrawals or transfers per month without incurring fees. 3. Competitive interest rates. Money market accounts often offer higher interest rates compared to traditional savings accounts. While the rates may vary depending on market conditions and the financial institution, money market accounts generally provide a better return on investment. 4. Diversification. Money market accounts can be a valuable addition to a diversified investment portfolio. By allocating a portion of your savings to a money market account, you can balance the risk and potential returns of other investments such as stocks or bonds. 5. Flexibility. Money market accounts offer flexibility in terms of deposit and withdrawal amounts. While some accounts may have minimum balance requirements, they generally allow individuals to deposit or withdraw funds as needed, making them suitable for short-term savings goals or emergency funds. 6.4.4 Considerations for money market accounts. While money market accounts offer numerous benefits, it is essential to consider a few factors before opening an account. 1. Fees and minimum balance requirements. Some money market accounts may have fees associated with maintaining the account or falling below the minimum balance requirement. It is crucial to review the terms and conditions of the account to understand any potential fees that may be incurred. 2. Interest rate fluctuations. Interest rates on money market accounts can fluctuate over time. It is important to monitor the interest rate environment and compare rates offered by different financial institutions to ensure you are getting the best possible return on your investment. 3. Inflation risk. While money market accounts provide a safe and secure investment option, they may not always keep pace with inflation. Inflation erodes the purchasing power of money over time, so it is important to consider the impact of inflation on the real value of your savings. 6.4.5 Conclusion. Money market accounts offer individuals the opportunity to earn compound interest on their savings while maintaining safety and liquidity. These accounts provide a balance between risk and return, making them a popular choice for short-term savings goals or emergency funds. By understanding the benefits and considerations of money market accounts, individuals can make informed decisions about how to leverage compound interest to grow their wealth. 7. Compound interest and retirement accounts. 7.1 Compound interest in 401k plans. A 401k plan is a type of retirement savings account offered by many employers in the United States. It is named after the section of the Internal Revenue Code that governs it. The primary purpose of a 401k plan is to provide employees with a tax-advantaged way to save for retirement. 7.1.1 What is a 401k plan? A 401k plan is a defined contribution retirement plan, which means that the amount of money you accumulate in the plan depends on the contributions you make and the investment performance of those contributions. Unlike a traditional pension plan, where the employer bears the investment risk, in a 401k plan, the employee is responsible for managing their own investments. 7.1.2 How does compound interest work in a 401k plan? Compound interest plays a crucial role in the growth of your 401k plan. When you contribute to your 401k account, your contributions are invested in various financial instruments such as stocks, bonds, and mutual funds. Over time, these investments generate returns, which are reinvested back into your account. This reinvestment of returns, along with your contributions, leads to the compounding effect. The power of compound interest in a 401k plan lies in the fact that not only do your contributions grow over time, but the returns on your investments also generate additional returns. This compounding effect can significantly boost the growth of your retirement savings. 7.1.3 Employer matching contributions. One of the key advantages of a 401k plan is the potential for employer matching contributions. Many employers offer a matching contribution as an incentive for employees to save for retirement. This means that for every dollar you contribute to your 401k plan, your employer will contribute a certain percentage of that amount, up to a specified limit. Employer matching contributions are essentially free money that can accelerate the growth of your retirement savings. When combined with the power of compound interest, employer matching contributions can have a substantial impact on the overall value of your 401k plan. 7.1.4 Tax benefits of a 401k plan. Another advantage of a 401k plan is the tax benefits it offers. Contributions to a traditional 401k plan are made on a pre-tax basis, which means that the money you contribute is deducted from your taxable income in the year of contribution. This reduces your current tax liability and allows you to defer paying taxes on your contributions and investment earnings until you withdraw the funds in retirement. Additionally, some employers offer a Roth 401k option, where contributions are made on an after-tax basis. While contributions to a Roth 401k are not tax-deductible, qualified withdrawals in retirement are tax-free, including the investment earnings. 7.1.5 Contribution limits investing. It is important to be aware of the contribution limits investing rules associated with a 401k plan. The Internal Revenue Service (IRS) sets annual limits on the amount of money you can contribute to your 401k plan. These limits are subject to change and may vary depending on your age and income level. Vesting refers to the ownership of the employer matching contributions in your 401k plan. Some employers have a vesting schedule that determines how long you must work for the company before you are entitled to the full value of the employer matching contributions. It is essential to understand your employer's vesting schedule to maximize the benefits of the matching contributions. 7.1.6 Managing your 401k investments. To make the most of compound interest in your 401k plan, it is crucial to have a well-diversified investment strategy. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, and cash equivalents, to reduce the risk of any single investment negatively impacting your overall portfolio. Many 401k plans offer a range of investment options, including mutual funds and target date funds. It is important to review and understand the investment options available to you and choose those that align with your risk tolerance and long-term financial goals. Regularly monitoring and rebalancing your 401k investments is also essential. As the market fluctuates, the allocation of your investments may deviate from your desired asset allocation. Rebalancing involves adjusting your investments to maintain your desired asset allocation and ensure that your portfolio remains aligned with your long-term investment strategy. 7.1.7 Withdrawing funds from a 401k plan. Withdrawals from a 401k plan are generally subject to income tax and may be subject to an early withdrawal penalty if taken before age 59.5. However, there are certain exceptions to the early withdrawal penalty, such as financial hardship or disability. When you reach the age of 72, you are required to start taking minimum distributions from your 401k plan, known as Required Minimum Distributions (RMDs). RMDs are calculated based on your life expectancy and the value of your account. Failing to take the required minimum distributions can result in significant tax penalties. 7.1.8 Seeking professional advice. Managing a 401k plan and maximizing the benefits of compound interest can be complex. It is advisable to seek the guidance of a financial advisor who specializes in retirement planning. A professional can help you develop a personalized investment strategy, navigate the tax implications, and ensure that your 401k plan aligns with your long-term financial goals. In conclusion, compound interest plays a vital role in the growth of your 401k plan. By taking advantage of employer matching contributions, understanding the tax benefits, and managing your investments wisely, you can harness the power of compound interest to build a substantial retirement nest egg. Remember to regularly review and adjust your investment strategy to stay on track towards achieving your retirement goals. 7.2 Compound Interest and Individual Retirement Accounts (IRAs). Individual retirement accounts (IRAs) are a popular investment vehicle for individuals looking to save for retirement. These accounts offer tax advantages and the potential for compound interest growth over time. In this section, we will explore how compound interest works within IRAs and the benefits it can provide for retirement planning. 7.2.1 Understanding Individual Retirement Accounts (IRAs). An individual retirement account (IRA) is a type of investment account that allows individuals to save for retirement while enjoying certain tax advantages. IRAs are offered by financial institutions such as banks, brokerage firms, and mutual fund companies. There are two main types of IRAs: traditional IRAs and Roth IRAs. Traditional IRAs allow individuals to make tax-deductible contributions, meaning that the contributions are made with pre-tax dollars. The earnings within the account grow tax-deferred until withdrawals are made during retirement, at which point they are subject to income tax. Roth IRAs, on the other hand, are funded with after-tax dollars, meaning that contributions are not tax-deductible. However, the earnings within a Roth IRA grow tax-free, and qualified withdrawals are also tax-free. 7.2.2 The Power of Compound Interest in IRAs. Compound interest plays a significant role in the growth of retirement savings within IRAs. When you contribute to an IRA, your money has the potential to grow exponentially over time due to the compounding effect. Compound interest is the interest earned on both the initial investment and any accumulated interest from previous periods. Let's consider an example to illustrate the power of compound interest in an IRA. Suppose you contribute $5,000 to a traditional IRA at the age of 30 and continue to contribute $5,000 annually until you retire at the age of 65. Assuming an average annual return of 7%, your initial investment of $5,000 would grow to over $760,000 by the time you retire. This growth is primarily due to the compounding effect of earning interest on your contributions and the accumulated interest over the years. 7.2.3 Maximizing compound interest in IRAs. To maximize the benefits of compound interest within IRAs, it is essential to start saving early and contribute consistently. The earlier you begin contributing to an IRA, the more time your investments have to grow and compound. Even small contributions made consistently over a long period can result in significant retirement savings. Additionally, it is crucial to choose the right investments within your IRA to maximize compound interest. Depending on your risk tolerance and investment goals, you can allocate your IRA funds to a variety of investment options such as stocks, bonds, mutual funds, or exchange-traded funds (ETFs). It is advisable to diversify your investments to spread the risk and potentially enhance returns. 7.2.4 Tax Advantages of IRAs and Compound Interest. One of the significant advantages of IRAs is the tax benefits they offer. Traditional IRAs provide a tax deduction for contributions, which can lower your taxable income in the year of contribution. This tax savings can be reinvested within the IRA, allowing for additional compound interest growth. Roth IRAs, although not providing an immediate tax deduction, offer tax-free growth and tax-free withdrawals in retirement. This means that all the compound interest earned within a Roth IRA is not subject to income tax, providing a significant advantage over taxable investment accounts. 7.2.5 Withdrawals and Required Minimum Distributions (RMDs). It is important to note that IRAs are designed for retirement savings, and there are specific rules regarding withdrawals. With traditional IRAs, withdrawals are generally subject to income tax in the year they are taken. Additionally, starting at age 72, individuals with traditional IRAs are required to take minimum distributions known as Required Minimum Distributions (RMDs) each year. Roth IRAs, on the other hand, offer more flexibility when it comes to withdrawals. Since contributions to a Roth IRA are made with after-tax dollars, qualified withdrawals of both contributions and earnings are tax-free. Furthermore, Roth IRAs do not have RMDs during the account owner's lifetime, allowing for more control over the timing and amount of withdrawals. 7.2.6 Considerations and Limitations of IRAs. While IRAs offer many advantages for retirement savings, there are certain considerations and limitations to keep in mind. Firstly, there are annual contribution limits for both traditional and Roth IRAs, which are set by the Internal Revenue Service (IRS). These limits may change over time, so it is essential to stay informed about the current limits. Additionally, there are income limits that determine eligibility for certain tax benefits associated with IRAs. For example, the ability to deduct contributions to a traditional IRA may be limited if you or your spouse participates in an employer-sponsored retirement plan and your income exceeds a certain threshold. Lastly, early withdrawals from IRAs before the age of 59.5 may be subject to a 10% penalty in addition to income tax, unless an exception applies. It is generally advisable to keep funds within an IRA until retirement to fully benefit from the power of compound interest. In conclusion, individual retirement accounts (IRAs) provide individuals with a powerful tool for saving for retirement. By taking advantage of the tax benefits and harnessing the power of compound interest, individuals can grow their retirement savings significantly over time. It is important to understand the different types of IRAs, contribute consistently, choose appropriate investments, and consider the rules and limitations associated with withdrawals. With careful planning and a long-term perspective, IRAs can play a crucial role in achieving a financially secure retirement. 7.3 Compound Interest and Roth IRAs. A Roth Individual Retirement Account (IRA) is a powerful tool for retirement savings that can greatly benefit from the concept of compound interest. In this section, we will explore how compound interest works within the context of Roth IRAs and how it can help you maximize your retirement savings. 7.3.1 Understanding Roth IRAs. Before diving into the specifics of compound interest and Roth IRAs, let's first understand what a Roth IRA is. A Roth IRA is a type of retirement account that offers tax advantages for individuals who meet certain income requirements. Unlike traditional IRAs, contributions to a Roth IRA are made with after-tax dollars, meaning you don't get an immediate tax deduction. However, the earnings within a Roth IRA grow tax-free, and qualified withdrawals in retirement are also tax-free. 7.3.2 The power of compound interest in Roth IRAs. Compound interest is the concept of earning interest on both the initial investment and the accumulated interest over time. It is often referred to as interest on interest. The power of compound interest lies in its ability to exponentially grow your savings over time. In the case of Roth IRAs, the earnings generated within the account are reinvested and continue to grow tax-free. This means that the interest earned on your initial contributions, as well as the interest earned on the accumulated earnings, can compound over the years, leading to significant growth in your retirement savings. 7.3.3 Contributions and compound interest. One of the key factors that determine the growth of your Roth IRA through compound interest is the amount and frequency of your contributions. The more you contribute to your Roth IRA, the more you can take advantage of the power of compound interest. By consistently making contributions to your Roth IRA, you are not only increasing the principal amount on which compound interest is calculated but also allowing more time for the interest to compound. This can have a substantial impact on the overall growth of your retirement savings. 7.3.4 Time horizon and compound interest. Another crucial aspect of compound interest in Roth IRAs is the time horizon. The longer you have until retirement, the more time your contributions have to grow through compound interest. Starting early and contributing regularly to your Roth IRA can significantly enhance the potential growth of your retirement savings. Even small contributions made early on can have a substantial impact due to the extended time period for compound interest to work its magic. By taking advantage of the power of compound interest and starting early, you can potentially accumulate a significant nest egg for your retirement. 7.3.5 Investment returns and compound interest. The investment returns within your Roth IRA play a vital role in the growth of your retirement savings through compound interest. The higher the returns on your investments, the greater the potential for compound interest to work in your favor. It is important to carefully consider the investment options within your Roth IRA and choose investments that have the potential to generate higher returns over the long term. However, it is also crucial to balance the potential for higher returns with the level of risk you are comfortable with, as higher returns often come with increased volatility. 7.3.6 Maximizing compound interest in Roth IRAs. To maximize the benefits of compound interest in your Roth IRA, it is essential to follow a few key strategies. Start early. The earlier you start contributing to your Roth IRA, the more time your investments have to grow through compound interest. Contribute regularly. Consistent contributions to your Roth IRA allow for a steady increase in the principal amount and more time for compound interest to work its magic. Choose the right investments. Select investments within your Roth IRA that have the potential to generate higher returns over the long term, while considering your risk tolerance. Reinvest dividends and interest. Instead of withdrawing the dividends and interest earned within your Roth IRA, reinvest them to take full advantage of compound interest. Avoid early withdrawals. Withdrawing funds from your Roth IRA before retirement can significantly hinder the potential growth of your retirement savings through compound interest. Try to keep your contributions invested for the long term. By following these strategies, you can harness the power of compound interest within your Roth IRA and potentially achieve a more comfortable and secure retirement. 7.3.7 Tax advantages of Roth IRAs. In addition to the benefits of compound interest, Roth IRAs offer unique tax advantages. Since contributions to a Roth IRA are made with after-tax dollars, qualified withdrawals in retirement are tax-free. This can be particularly advantageous if you expect to be in a higher tax bracket during retirement. Furthermore, Roth IRAs do not have required minimum distributions, RMDs, during the account holder's lifetime. This means that you can continue to let your investments grow tax-free for as long as you wish, providing even more potential for compound interest to work its magic. 7.3.8 Conclusion. Compound interest is a powerful force that can greatly enhance your retirement savings, and Roth IRAs provide an excellent vehicle to take advantage of this concept. By understanding how compound interest works within the context of Roth IRAs and following the strategies outlined in this section, you can maximize the growth of your retirement savings and potentially achieve a more financially secure future. Start early, contribute regularly, choose the right investments, and let compound interest work for you in your Roth IRA. 7.4 Compound interest and pension plans. Pension plans are an essential component of retirement planning, providing individuals with a reliable source of income during their golden years. When it comes to building wealth and securing a comfortable retirement, compound interest plays a crucial role in the success of pension plans. In this section, we will explore how compound interest can maximize the growth of pension funds and help individuals achieve their retirement goals. 7.4.1 Understanding pension plans. Before delving into the impact of compound interest on pension plans, it is important to have a clear understanding of what a pension plan entails. A pension plan is a retirement savings vehicle that is typically sponsored by an employer or a government entity. It is designed to provide employees with a steady income stream after they retire. Pension plans can take various forms, such as defined benefit plans and defined contribution plans. In a defined benefit plan, the employer guarantees a specific amount of income to the employee upon retirement, based on factors such as salary and years of service. On the other hand, defined contribution plans, such as 401k plans and IRAs, allow employees to contribute a portion of their salary to a retirement account, with the employer sometimes matching a percentage of the contribution. 7.4.2 The power of compound interest in pension plans. Compound interest is a powerful force that can significantly enhance the growth of pension funds over time. It is the concept of earning interest not only on the initial investment but also on the accumulated interest from previous periods. This compounding effect can lead to exponential growth and substantial wealth accumulation. In the context of pension plans, compound interest works by reinvesting the earnings generated by the pension fund back into the account. As the fund grows, the interest earned in subsequent periods becomes larger, resulting in a compounding effect. This compounding effect is particularly advantageous in long-term retirement planning, as it allows individuals to benefit from the growth of their investments over several decades. 7.4.3 Maximizing compound interest in pension plans. To maximize the power of compound interest in pension plans, individuals should consider the following strategies. 7.4.3.1 Start early and contribute regularly. One of the most effective ways to harness the power of compound interest is to start saving for retirement as early as possible. The earlier individuals begin contributing to their pension plans, the longer their investments have to grow and compound. By making regular contributions over time, individuals can take full advantage of the compounding effect and significantly increase their retirement savings. 7.4.3.2 Take advantage of employer matching contributions. If your employer offers a matching contribution program, it is crucial to take full advantage of this benefit. Employer matching contributions are essentially free money that can boost the growth of your pension fund. By contributing enough to receive the maximum matching contribution from your employer, you can accelerate the growth of your retirement savings through the power of compound interest. 7.4.3.3 Optimize investment allocation. Properly allocating your pension plan investments is essential for maximizing compound interest. Depending on your risk tolerance and retirement goals, you may choose to invest in a diversified portfolio of stocks, bonds, and other assets. It is important to regularly review and adjust your investment allocation to ensure it aligns with your long-term retirement objectives. 7.4.3.4 Avoid early withdrawals. While it may be tempting to withdraw funds from your pension plan before retirement, doing so can significantly hinder the power of compound interest. Early withdrawals not only reduce the principal amount but also disrupt the compounding effect. It is advisable to leave your pension funds untouched until you reach retirement age to fully benefit from the growth potential of compound interest. 7.4.4 The role of pension plan providers. Pension plan providers, such as financial institutions and employers, play a crucial role in facilitating the growth of retirement savings through compound interest. These providers are responsible for managing the pension funds, investing the contributions, and ensuring the funds are well positioned to generate optimal returns. When selecting a pension plan provider, it is important to consider factors such as fees, investment options, and the provider's track record. By choosing a reputable and experienced provider, individuals can have confidence in the management of their pension funds and the potential for compound interest to work in their favor. 7.4.5 Monitoring and adjusting pension plans. As with any investment strategy, it is essential to regularly monitor and adjust your pension plan to ensure it remains aligned with your retirement goals. Life circumstances, market conditions, and personal objectives may change over time, necessitating adjustments to your pension plan. By staying proactive and making necessary modifications, you can optimize the growth potential of compound interest and ensure your retirement savings are on track. In conclusion, compound interest plays a vital role in the success of pension plans. By understanding the power of compound interest and implementing strategies to maximize its impact, individuals can significantly enhance the growth of their retirement savings. Starting early, contributing regularly, taking advantage of employer matching contributions, optimizing investment allocation, and avoiding early withdrawals are key steps in harnessing the power of compound interest in pension plans. By working with reputable pension plan providers and regularly monitoring and adjusting your plan, you can ensure that compound interest works in your favor and helps you achieve a financially secure retirement. 8. Compound interest and education savings. 8.1 Compound interest and 529 plans. A 529 plan is a tax-advantaged savings plan designed to help families save for future education expenses. It is named after Section 529 of the Internal Revenue Code, which governs these types of plans. One of the key advantages of a 529 plan is the power of compound interest, which can significantly enhance the growth of your savings over time. 8.1.1 Understanding compound interest in 529 plans. Compound interest is a fundamental concept in finance that allows your money to grow exponentially over time. It is the interest earned on both the initial principal and any accumulated interest. In the context of a 529 plan, compound interest plays a crucial role in maximizing the growth of your education savings. When you contribute to a 529 plan, your money is invested in various investment options such as mutual funds or exchange-traded funds (ETFs). These investments generate returns, which are reinvested back into the plan. Over time, the compounding effect of these reinvested returns can significantly boost the value of your 529 plan. 8.1.2 The power of compound interest in 529 plans. The power of compound interest lies in its ability to generate earnings on both your initial contributions and the accumulated interest. As time goes on, the growth of your savings accelerates, thanks to the compounding effect. The longer your money remains invested in a 529 plan, the greater the potential for compound interest to work its magic. Let's consider an example to illustrate the power of compound interest in a 529 plan. Suppose you start saving for your child's education when they are born and contribute $5,000 annually to their 529 plan. Assuming an average annual return of 7%, after 18 years, your total contributions would amount to $90,000. However, due to the compounding effect, the value of your 529 plan could be significantly higher, potentially exceeding $160,000. 8.1.3 Maximizing compound interest in 529 plans. To maximize the benefits of compound interest in your 529 plan, it's essential to start saving as early as possible. The longer your money has to grow, the more significant the impact of compound interest. By starting early, you give your savings more time to compound and potentially reach your education savings goals. Additionally, regularly contributing to your 529 plan can further enhance the power of compound interest. By consistently adding to your savings, you increase the principal amount on which compound interest is calculated. This, in turn, leads to even greater growth over time. It's also crucial to choose the right investment options within your 529 plan. Different investment options offer varying levels of risk and potential returns. While higher risk investments may offer the potential for greater growth, they also come with increased volatility. It's important to strike a balance between risk and reward based on your individual circumstances and risk tolerance. 8.1.4 Tax advantages of compound interest in 529 plans. One of the significant advantages of 529 plans is their tax benefits. The growth of your savings in a 529 plan is tax deferred, meaning you don't have to pay taxes on the earnings as long as the funds are used for qualified education expenses. This tax-deferred growth allows compound interest to work its magic without the drag of annual taxes. Furthermore, many states offer additional tax incentives for contributing to a 529 plan. These incentives can include deductions or credits on state income taxes, further enhancing the potential growth of your savings. 8.1.5 Using compound interest to reach education savings goals. Compound interest can be a powerful tool in helping you reach your education savings goals. By taking advantage of the compounding effect, you can potentially accumulate a significant amount of money over time. However, it's important to set realistic goals and regularly monitor your progress. When setting your education savings goals, consider factors such as the cost of tuition, room and board, books, and other expenses. By estimating these costs and factoring in the potential growth of your 529 plan through compound interest, you can determine how much you need to save each year to reach your target. Regularly monitoring your 529 plan's performance and adjusting your contributions as needed is essential. As your child gets closer to college age, you may want to adjust your investment strategy to reduce risk and preserve the capital you've accumulated. By staying actively involved in managing your 529 plan, you can make informed decisions to ensure you're on track to meet your education savings goals. In conclusion, compound interest is a powerful force that can significantly enhance the growth of your savings in a 529 plan. By understanding how compound interest works and taking advantage of its benefits, you can maximize the potential growth of your education savings. Start early, contribute regularly, choose the right investments, and monitor your progress to make the most of compound interest in your 529 plan. 8.2 Compound Interest and Coverdell Education Savings Accounts (ESAs). A Coverdell Education Savings Account (ESA) is a type of investment account that offers tax advantages for saving and investing funds specifically for education expenses. It is a powerful tool that can help individuals and families save for educational expenses, such as tuition, books, and other qualified education-related costs. By utilizing compound interest within a Coverdell ESA, individuals can maximize their savings and potentially grow their investments over time. 8.2.1 Understanding Coverdell Education Savings Accounts (ESAs). A Coverdell ESA is a tax-advantaged savings account that allows individuals to contribute up to $2,000 per year per beneficiary until the beneficiary reaches the age of 18. The contributions made to a Coverdell ESA are not tax-deductible, but the earnings within the account grow tax-free. This means that any investment gains or interest earned within the account are not subject to federal income tax as long as the funds are used for qualified education expenses. 8.2.2 The power of compound interest in Coverdell ESAs. Compound interest plays a significant role in maximizing the growth potential of funds within a Coverdell ESA. When contributions are made to the account, they have the opportunity to earn interest or investment gains. Over time, these earnings are reinvested and can generate additional returns. As a result, the account balance can grow exponentially, especially when contributions are made consistently and early on. The compounding effect of interest allows the account balance to increase not only based on the initial contributions but also on the accumulated interest or investment gains. This means that the interest earned in one period becomes part of the principal for the next period, leading to even more significant growth over time. The longer the funds remain invested, the greater the potential for compound interest to work its magic. 8.2.3 Maximizing compound interest in Coverdell ESAs. To maximize the power of compound interest within a Coverdell ESA, it is essential to start saving and investing as early as possible. The earlier contributions are made, the longer the funds have to grow and compound. By starting early, individuals can take advantage of the time value of money and potentially accumulate a substantial amount of savings by the time the beneficiary reaches college age. Consistency is also key when it comes to maximizing compound interest. Regular contributions to the Coverdell ESA ensure that funds are consistently being invested and have the opportunity to grow over time. By making contributions on a regular basis, individuals can take advantage of dollar-cost averaging, which can help smooth out the impact of market fluctuations and potentially enhance long-term returns. Additionally, it is important to choose appropriate investments within the Coverdell ESA that align with the desired risk tolerance and time horizon. While the specific investment options may vary depending on the financial institution managing the account, it is crucial to consider investments that have the potential to generate reasonable returns over the long term. Balancing risk and reward is essential to ensure that the funds within the account have the opportunity to grow through compound interest while also managing potential volatility. 8.2.4 Withdrawing funds from Coverdell ESAs. When it comes time to use the funds within a Coverdell ESA for qualified education expenses, it is important to understand the rules and limitations surrounding withdrawals. Qualified education expenses include tuition, fees, books, supplies, and equipment required for enrollment or attendance at an eligible educational institution. It is crucial to note that any non-qualified withdrawals from a Coverdell ESA may be subject to income tax and a 10% penalty on the earnings portion of the withdrawal. Therefore, it is essential to plan and use the funds within the account for qualified education expenses to avoid any potential tax consequences. 8.2.5 Coverdell ESAs and other education savings options. While Coverdell ESAs offer tax advantages for education savings, it is important to consider other education savings options as well. Other popular options include 529 plans and custodial accounts, UTMA, UGMA. Each option has its own set of rules, advantages, and limitations, so it is crucial to evaluate and compare them based on individual circumstances and goals. In conclusion, a Coverdell Education Savings Account (ESA) is a valuable tool for saving and investing funds specifically for education expenses. By harnessing the power of compound interest within a Coverdell ESA, individuals can potentially grow their savings over time and maximize their ability to fund educational pursuits. Starting early, contributing consistently, and choosing appropriate investments are key factors in maximizing the benefits of compound interest within a Coverdell ESA. 8.3 Compound Interest and Education Savings Bonds. Education is a valuable investment in the future, and saving for educational expenses is a crucial part of financial planning. While there are various options available for saving for education, one option that can provide a stable and secure way to grow your savings is through education savings bonds. 8.3.1 What are education savings bonds? Education savings bonds, also known as Series E or Series 1 savings bonds, are a type of government-issued bond specifically designed to help families save for education expenses. These bonds are backed by the U.S. Department of the Treasury and offer a safe and reliable way to accumulate funds for educational purposes. 8.3.2 How do education savings bonds work? Education savings bonds work by allowing individuals to invest a certain amount of money into the bond, which then earns interest over time. The interest on these bonds is typically tax-free if used for qualified educational expenses, making them an attractive option for families looking to save for education. When you purchase an education savings bond, you are essentially lending money to the government. The bond has a fixed interest rate that is determined at the time of purchase. The interest on the bond accrues monthly and is compounded semi-annually, meaning that the interest you earn on the bond also earns interest. 8.3.3 Benefits of education savings bonds. Education savings bonds offer several benefits that make them an appealing option for individuals looking to save for education. 1. Safety and security. Education savings bonds are backed by the U.S. government, making them one of the safest investment options available. The government guarantees the principal and interest on these bonds, providing peace of mind to investors. 2. Tax advantages. One of the significant advantages of education savings bonds is the potential for tax-free interest. If the bond proceeds are used for qualified educational expenses, such as tuition, fees, and books, the interest earned on the bond is exempt from federal income tax. This tax advantage can help maximize the growth of your savings. 3. Flexibility. Education savings bonds offer flexibility in terms of their use. While they are primarily designed for educational expenses, they can also be used for other purposes if needed. However, it's important to note that if the bond proceeds are not used for qualified educational expenses, the interest may be subject to federal income tax. 4. Accessibility. Education savings bonds are easily accessible and can be purchased directly from the U.S. Department of the Treasury's website or through financial institutions. They have a low minimum investment requirement, making them accessible to individuals with varying financial means. 8.3.4 Considerations for education savings bonds. While education savings bonds offer several advantages, it's essential to consider a few factors before investing. 1. Rate of return. Education savings bonds typically offer a fixed interest rate that is determined at the time of purchase. It's important to compare the rate of return on these bonds with other investment options to ensure that you are maximizing your savings potential. 2. Time horizon. The time horizon for your education savings goals is an important consideration. Education savings bonds have a maturity period of up to 30 years, and while you can redeem them before maturity, there may be penalties for early withdrawal. It's crucial to align the maturity period of the bond with your education savings timeline. 3. Other investment options. Education savings bonds are just one of many investment options available for saving for education. It's important to explore other options, such as 529 plans or Coverdell education savings accounts, to determine which option best suits your financial goals and risk tolerance. 8.3.5 Conclusion. Education savings bonds can be a valuable tool for saving for educational expenses. They offer safety, tax advantages, and flexibility, making them an attractive option for individuals looking to grow their savings for education. However, it's important to carefully consider the rate of return, time horizon, and other investment options before making a decision. By incorporating education savings bonds into your overall financial plan, you can take a significant step towards securing a bright future for yourself or your loved ones through education. 8.4 Compound interest and scholarships. Scholarships are a valuable resource for students seeking financial assistance to pursue their education. While compound interest is often associated with investments and savings, it can also play a role in maximizing the benefits of scholarships. In this section, we will explore how compound interest can be utilized to make the most of scholarship funds and create a lasting impact on a student's financial future. 8.4.1 Investing scholarship funds. When a student receives a scholarship, they have the opportunity to invest the funds wisely to potentially grow their value over time. By understanding the principles of compound interest, students can make informed decisions about how to allocate their scholarship funds for long-term financial benefit. One option is to invest the scholarship funds in a diversified portfolio of stocks, bonds, or mutual funds. By doing so, students can take advantage of the power of compound interest to potentially earn returns on their investments. Over time, the initial scholarship amount, combined with the compounded returns, can grow significantly, providing additional financial resources for future educational expenses or other financial goals. 8.4.2 Starting early for maximum impact. The key to maximizing the benefits of compound interest with scholarship funds is to start investing early. The longer the funds are invested, the more time they have to grow through the power of compounding. By starting early, students can potentially accumulate a substantial amount of wealth by the time they graduate or enter the workforce. For example, let's consider a student who receives a $10,000 scholarship and decides to invest it in a diversified portfolio with an average annual return of 8%. If the student leaves the funds invested for 4 years during their undergraduate studies, the value of the scholarship could grow to approximately $12,597. However, if the student continues to invest the funds for an additional 10 years after graduation, the value could increase to around $31,058. This demonstrates the significant impact that compound interest can have on scholarship funds when given enough time to grow. 8.4.3 Reinvesting scholarship returns. Another strategy to maximize the benefits of compound interest with scholarship funds is to reinvest any returns earned from the initial investment. Rather than spending the returns, students can choose to reinvest them back into the portfolio, allowing the power of compounding to work its magic. By reinvesting the returns, students can accelerate the growth of their scholarship funds over time. The compounding effect becomes even more powerful as the returns themselves generate additional returns. This strategy can help students build a substantial financial foundation that can support their educational pursuits and future financial goals. 8.4.4 Compound interest and loan repayment. Compound interest can also be utilized to manage student loan debt effectively. Scholarships can help reduce the need for student loans, but in cases where loans are still necessary, understanding compound interest can be beneficial. By making regular payments towards student loans, students can reduce the principal balance and minimize the amount of interest that accrues over time. This can help students save money in the long run and pay off their loans faster. Additionally, any extra funds, such as scholarship awards, can be applied directly to the principal balance, further reducing the overall interest paid. 8.4.5 Scholarships and Financial Independence. Scholarships can play a significant role in achieving financial independence. By utilizing compound interest strategies with scholarship funds, students can create a solid financial foundation that can support their educational journey and beyond. By investing scholarship funds wisely, starting early, and reinvesting returns, students can potentially grow their scholarship funds into a substantial amount of wealth. This can provide financial security, reduce the need for student loans, and open up opportunities for pursuing higher education without the burden of excessive debt. 8.4.6 Scholarships and Long-Term Financial Goals. In addition to supporting educational expenses, scholarships can also contribute to long-term financial goals. By utilizing compound interest strategies, students can grow their scholarship funds over time and use them to achieve other financial milestones, such as purchasing a home, starting a business, or saving for retirement. By understanding the principles of compound interest and making informed investment decisions, students can leverage their scholarship funds to create a lasting impact on their financial future. With careful planning and a long-term perspective, scholarships can serve as a valuable tool for building wealth and achieving financial success. In conclusion, compound interest can be a powerful tool when it comes to maximizing the benefits of scholarships. By investing scholarship funds wisely, starting early, reinvesting returns, and utilizing compound interest strategies for loan repayment, students can create a solid financial foundation that supports their educational journey and long-term financial goals. Scholarships, combined with the principles of compound interest, can pave the way for financial independence and a brighter future. 9. Compound interest and debt repayment. 9.1 Using compound interest to pay off credit card debt. Credit card debt can be a significant burden for many individuals and families. The high interest rates associated with credit cards can make it challenging to pay off the debt and can lead to a cycle of increasing balances. However, by understanding and utilizing the power of compound interest, it is possible to develop a strategy to pay off credit card debt more efficiently and save money in the long run. 9.1.1 Understanding compound interest in the context of credit card debt. Compound interest is the concept of earning interest on both the initial principal amount and the accumulated interest. In the context of credit card debt, compound interest works against you. When you carry a balance on your credit card, the interest compounds daily, meaning that the interest is added to the outstanding balance, and future interest is calculated based on the new total. For example, let's say you have a credit card balance of $5,000 with an annual interest rate of 20%. If you make only the minimum monthly payment, the interest will continue to compound, and it will take you much longer to pay off the debt. By understanding how compound interest affects your credit card debt, you can take steps to minimize its impact and pay off your debt faster. 9.1.2 Developing a strategy to pay off credit card debt. To effectively use compound interest to pay off credit card debt, you need to develop a strategy that focuses on reducing the principal balance as quickly as possible. Here are some steps you can take. Step 1. Assess your debt. Start by assessing your credit card debt. Make a list of all your credit cards, their outstanding balances, and the interest rates associated with each. This will give you a clear picture of your overall debt and help you prioritize which cards to tackle first. Step 2. Create a budget. Developing a budget is crucial when it comes to paying off credit card debt. Take a close look at your income and expenses and identify areas where you can cut back. Allocate as much money as possible towards paying off your credit card debt while still meeting your essential expenses. Step 3. Pay more than the minimum. Paying only the minimum monthly payment will keep you trapped in a cycle of debt. To make a significant impact on your credit card balance, aim to pay more than the minimum payment each month. By paying more, you reduce the principal balance faster, which in turn reduces the amount of interest that compounds. Step 4. Prioritize high-interest debt. Focus on paying off the credit card with the highest interest rate first. By targeting the highest interest rate card, you minimize the amount of interest that compounds over time. Once you have paid off the highest interest rate card, move on to the next one. Step 5. Consider balance transfers or consolidation. If you have multiple credit cards with high interest rates, consider transferring the balances to a card with a lower interest rate or consolidating your debt into a personal loan. This can help reduce the overall interest you pay and make it easier to manage your debt. Step 6. Avoid new debt. While paying off your credit card debt, it is essential to avoid accumulating new debt. Cut back on unnecessary expenses and focus on living within your means. By avoiding new debt, you can prevent the compounding effect of interest from working against you. 9.1.3 The benefits of using compound interest to pay off credit card debt. By utilizing compound interest to pay off credit card debt, you can experience several benefits. Faster debt repayment. By paying more than the minimum payment and targeting high interest debt, you can accelerate the repayment process. As you reduce the principal balance faster, the amount of interest that compounds decreases, allowing you to pay off your debt more quickly. Interest savings. By paying off your credit card debt faster, you save money on interest payments. The longer you carry a balance, the more interest compounds, increasing the overall cost of your debt. By using compound interest to your advantage, you can minimize the interest you pay and save money in the long run. Improved credit score. Paying off credit card debt can have a positive impact on your credit score. As you reduce your outstanding balances, your credit utilization ratio improves, which is a significant factor in determining your credit score. A higher credit score can open up opportunities for better interest rates and loan terms in the future. 9.1.4 Seeking professional help. If you find yourself overwhelmed with credit card debt and struggling to make progress, it may be beneficial to seek professional help. Credit counseling agencies and financial advisors can provide guidance and assistance in developing a personalized plan to pay off your credit card debt effectively. Remember, using compound interest to pay off credit card debt requires discipline and commitment. It may take time, but by implementing a strategic plan and staying focused on your goal, you can regain control of your finances and achieve a debt-free future. 9.2 Compound interest and student loan repayment. Student loans are a common form of debt that many individuals acquire to finance their education. These loans can have a significant impact on a person's financial well-being, and understanding how compound interest applies to student loan repayment is crucial for effectively managing this debt. 9.2.1 The basics of student loans. Before delving into compound interest and its implications for student loan repayment, it is essential to understand the basics of student loans. When individuals take out student loans, they borrow money from a lender to cover the costs of their education. These loans typically come with an interest rate, which is the cost of borrowing the money. Student loans can be divided into two main categories: federal loans and private loans. Federal loans are issued by the government and often offer more favorable terms, such as lower interest rates and flexible repayment options. Private loans, on the other hand, are provided by banks, credit unions, or other financial institutions and may have higher interest rates and fewer repayment options. 9.2.2 Compound interest and student loans. Compound interest plays a significant role in student loan repayment. Unlike simple interest, which is calculated only on the initial loan amount, compound interest is calculated on both the principal, the original loan amount, and any accumulated interest. When borrowers make payments towards their student loans, a portion of the payment goes towards reducing the principal, while the remaining amount is used to cover the interest charges. Over time, as the principal decreases, the interest charges also decrease. However, if borrowers do not make sufficient payments to cover the interest charges, the unpaid interest is added to the principal, resulting in the loan balance increasing. 9.2.3 The impact of compound interest on student loan repayment. The impact of compound interest on student loan repayment can be significant. As interest accrues on the loan balance, the total amount owed can increase over time, making it more challenging to pay off the debt. This is especially true for borrowers who make minimum payments or defer their loan payments while in school or during a grace period. Let's consider an example to illustrate the impact of compound interest on student loan repayment. Suppose a borrower has a $30,000 student loan with an interest rate of 6% and a repayment term of 10 years. Using a standard repayment plan, the borrower would need to make monthly payments of approximately $333. Over the course of the repayment period, the borrower would end up paying a total of around $39,960, with $9,960 being the interest charges. This means that the borrower would pay nearly one-third of the original loan amount in interest alone. 9.2.4 Strategies for managing student loan repayment. Given the potential impact of compound interest on student loan repayment, it is crucial to develop strategies to effectively manage this debt. Here are some strategies to consider. 9.2.4.1 Making extra payments. One effective way to minimize the impact of compound interest is by making extra payments towards the principal whenever possible. By paying more than the minimum required amount, borrowers can reduce the outstanding balance and decrease the overall interest charges. 9.2.4.2 Refinancing or consolidating loans. Another strategy is to explore loan refinancing or consolidation options. Refinancing involves obtaining a new loan with better terms, such as a lower interest rate, to pay off the existing student loans. Consolidation, on the other hand, combines multiple loans into a single loan, simplifying the repayment process. 9.2.4.3 Taking advantage of repayment plans. Federal student loans offer various repayment plans, such as income-driven repayment plans, which base the monthly payment amount on the borrower's income and family size. These plans can help borrowers manage their loan payments based on their financial circumstances. 9.2.4.4 Seeking loan forgiveness programs. Certain professions, such as teaching or public service, may qualify for loan forgiveness programs. These programs forgive a portion or all of the borrower's student loans after a specified period of service or meeting specific criteria. Exploring these options can help borrowers reduce their overall debt burden. 9.2.5 The importance of timely repayment. Timely repayment is crucial when it comes to managing student loans and minimizing the impact of compound interest. Missing payments or defaulting on student loans can have severe consequences, including damage to credit scores, wage garnishment, and even legal action. By staying organized, budgeting effectively, and making consistent payments, borrowers can stay on track with their student loan repayment and avoid the negative consequences associated with defaulting on their loans. 9.2.6 Seeking professional advice. Managing student loan repayment can be complex, and seeking professional advice can be beneficial. Financial advisors or student loan counselors can provide guidance on repayment strategies, loan consolidation, and other options available to borrowers. It is essential to research and choose reputable professionals who specialize in student loan repayment to ensure that the advice received is accurate and tailored to individual circumstances. Conclusion. Compound interest has a significant impact on student loan repayment. Understanding how compound interest works and implementing effective strategies can help borrowers manage their student loan debt more efficiently. By making extra payments, exploring refinancing options, taking advantage of repayment plans, and seeking loan forgiveness programs, borrowers can navigate the repayment process and minimize the long-term financial burden of student loans. 9.3 Compound interest and mortgage repayment. Purchasing a home is often one of the biggest financial decisions we make in our lives. For many people, taking out a mortgage is necessary to afford the home of their dreams. However, the process of repaying a mortgage can be daunting and overwhelming. This is where the concept of compound interest comes into play. 9.3.1 Understanding compound interest in mortgage repayment. Compound interest is a powerful force that can work for or against you when it comes to mortgage repayment. When you take out a mortgage, you are essentially borrowing money from a lender to purchase a property. In return, you agree to repay the loan over a specified period of time, typically with interest. The interest on a mortgage is calculated based on the outstanding balance of the loan. Initially, a larger portion of your monthly mortgage payment goes towards paying off the interest, while a smaller portion goes towards reducing the principal balance. However, as time goes on and you make regular payments, the balance of the loan decreases, and the interest portion of your payment becomes smaller. 9.3.2 The impact of compound interest on mortgage repayment. Compound interest can have a significant impact on the total amount you end up paying for your home. The longer the term of your mortgage, the more interest you will pay over time. This is because compound interest accumulates over the life of the loan, and the longer the loan term, the more time there is for interest to compound. For example, let's say you take out a 30-year mortgage for $300,000 with an interest rate of 4%. Over the course of the loan, you would end up paying a total of $515,609.89, with $215,609.89 being the amount of interest paid. This means that you would be paying more than half of the original loan amount in interest alone. 9.3.3 Strategies to minimize the impact of compound interest on mortgage repayment. While compound interest can seem overwhelming, there are strategies you can employ to minimize its impact on your mortgage repayment. Here are a few strategies to consider. 9.3.3.1 Making extra payments. One effective way to reduce the impact of compound interest is by making extra payments towards your mortgage. By making additional principal payments, you can reduce the outstanding balance of your loan faster, which in turn reduces the amount of interest that accrues over time. Even small additional payments can make a significant difference in the long run. 9.3.3.2 Refinancing. Refinancing your mortgage can also be a smart strategy to minimize the impact of compound interest. By refinancing at a lower interest rate, you can potentially save thousands of dollars over the life of the loan. However, it's important to carefully consider the costs associated with refinancing, such as closing costs and fees, to ensure that the savings outweigh the expenses. 9.3.3.3 Shortening the loan term. Another strategy to minimize the impact of compound interest is to shorten the term of your mortgage. By opting for a shorter loan term, such as a 15-year mortgage instead of a 30-year mortgage, you can significantly reduce the amount of interest paid over time. However, it's important to carefully consider whether you can comfortably afford the higher monthly payments associated with a shorter loan term. 9.3.4 The benefits of compound interest in mortgage repayment. While compound interest can work against you when it comes to mortgage repayment, it can also work in your favor. If you make regular payments towards your mortgage, you are effectively reducing the outstanding balance of the loan, which in turn reduces the amount of interest that accrues over time. This means that you can build equity in your home and potentially increase your net worth. Additionally, owning a home can provide you with the opportunity to leverage compound interest for other financial goals. For example, if you have built up equity in your home, you may be able to take out a home equity loan or line of credit to fund other investments or expenses. This can be a valuable tool for wealth accumulation and financial flexibility. 9.3.5 Conclusion. Compound interest plays a significant role in mortgage repayment. Understanding how compound interest works and its impact on your mortgage can help you make informed decisions to minimize its effects. By employing strategies such as making extra payments, refinancing, and shortening the loan term, you can reduce the amount of interest paid and potentially save thousands of dollars over the life of your mortgage. Additionally, owning a home and building equity can provide you with opportunities to leverage compound interest for other financial goals. 9.4 Compound interest and car loan repayment. When it comes to purchasing a car, many people rely on loans to finance their purchase. Car loans are a common form of debt that allows individuals to spread out the cost of a vehicle over a set period of time. However, it's important to understand the impact of compound interest on car loan repayment. 9.4.1 Understanding compound interest in car loans. Compound interest plays a significant role in car loan repayment. Unlike simple interest, which is calculated only on the principal amount, compound interest takes into account both the principal and the accumulated interest. This means that as interest accrues, it is added to the outstanding balance, and future interest calculations are based on the new, higher balance. Car loans typically have a fixed interest rate, which means that the interest rate remains constant throughout the loan term. The interest is usually calculated on a monthly basis, and the monthly payment is determined based on the loan amount, interest rate, and loan term. 9.4.2 The impact of compound interest on car loan repayment. Compound interest can significantly affect the total amount paid for a car over the life of the loan. The longer the loan term, the more interest will accumulate, resulting in a higher overall cost. It's important to consider the impact of compound interest when deciding on the loan term and monthly payment amount. For example, let's say you take out a car loan for $20,000 with an interest rate of 5% and a loan term of 5 years. Using compound interest, the total amount paid over the course of the loan would be higher than the initial loan amount. In this case, the total repayment amount would be approximately $22,040, with $2,040 being the accumulated interest. 9.4.3 Strategies for minimizing the impact of compound interest on car loans. While compound interest is an inherent part of car loan repayment, there are strategies you can employ to minimize its impact and save money in the long run. 9.4.3.1 Making larger monthly payments. One effective strategy is to make larger monthly payments than the minimum required amount. By paying more each month, you can reduce the outstanding balance faster, which in turn reduces the amount of interest that accrues. This can help you pay off the loan sooner and save on interest charges. 9.4.3.2 Shortening the loan term. Another way to minimize the impact of compound interest is to opt for a shorter loan term. While this may result in higher monthly payments, it can significantly reduce the total interest paid over the life of the loan. By paying off the loan sooner, you can save money and become debt-free faster. 9.4.3.3 Refinancing the loan. If you find yourself with a high-interest car loan, it may be worth considering refinancing. Refinancing involves obtaining a new loan with better terms to pay off the existing loan. By securing a lower interest rate or extending the loan term, you can potentially reduce the impact of compound interest and lower your monthly payments. 9.4.4 The importance of budgeting for car loan repayment. When taking out a car loan, it's crucial to consider the impact on your overall budget. Car loan payments, including the interest, should be factored into your monthly expenses to ensure you can comfortably afford the repayment. Failing to budget properly can lead to financial strain and potentially put you at risk of defaulting on the loan. 9.4.5 Paying off car loans early. If you have the means to do so, paying off your car loan early can be a wise financial decision. By making extra payments or paying off the loan in full before the end of the loan term, you can save on interest charges and free up your monthly budget for other financial goals. However, before paying off your car loan early, it's essential to check if there are any prepayment penalties or fees associated with early repayment. Some lenders impose penalties to compensate for the interest they would have earned over the full loan term. It's important to weigh the potential savings against any penalties to determine if early repayment is financially beneficial. 9.4.6 Conclusion. Compound interest has a significant impact on car loan repayment. Understanding how compound interest works and employing strategies to minimize its effect can help you save money and pay off your car loan more efficiently. By making larger monthly payments, shortening the loan term, considering refinancing options, and budgeting effectively, you can navigate car loan repayment with confidence and achieve your financial goals. 10. Compound interest and financial planning. 10.1 Incorporating compound interest into financial plans. When it comes to financial planning, incorporating compound interest into your strategy can be a game changer. The power of compound interest lies in its ability to exponentially grow your wealth over time. By understanding how compound interest works and leveraging it effectively, you can set yourself up for long-term financial success. 10.1.1 The basics of compound interest. Compound interest is the concept of earning interest on both the initial principal amount and the accumulated interest from previous periods. Unlike simple interest, which only calculates interest on the principal amount, compound interest allows your money to grow at an accelerated rate. To incorporate compound interest into your financial plans, it's crucial to start early. The earlier you begin investing or saving, the more time your money has to compound and grow. Even small contributions made consistently over a long period can result in significant wealth accumulation. 10.1.2 Setting financial goals. Before incorporating compound interest into your financial plans, it's essential to set clear and realistic financial goals. Whether your objective is to save for retirement, purchase a home, or fund your child's education, having specific goals will help guide your investment decisions. When setting financial goals, consider the time horizon and the amount of money needed to achieve them. Longer-term goals, such as retirement, may require more aggressive investment strategies to maximize the power of compound interest. Shorter-term goals, like saving for a down payment on a house, may require a more conservative approach to protect your principal. 10.1.3 Creating a compound interest strategy. Once you have established your financial goals, it's time to create a compound interest strategy. This strategy should align with your risk tolerance, time horizon, and desired rate of return. Diversification is a key component of any compound interest strategy. By spreading your investments across different asset classes, such as stocks, bonds, and real estate, you can reduce the risk associated with any single investment. Diversification helps protect your portfolio from market volatility and allows you to capture the long-term growth potential of various sectors. Another important aspect of your compound interest strategy is regular contributions. Consistently adding money to your investments or savings accounts allows you to take advantage of dollar cost averaging. This strategy involves investing a fixed amount at regular intervals, regardless of market conditions. Dollar cost averaging helps mitigate the impact of market fluctuations and can lead to better long-term returns. 10.1.4 Monitoring and adjusting compound interest plans. Incorporating compound interest into your financial plans is not a set-it-and-forget-it approach. It requires regular monitoring and adjustments to ensure you stay on track to meet your goals. Review your investment portfolio periodically to assess its performance and make any necessary adjustments. As you get closer to your financial goals, you may want to shift your investments to more conservative options to protect your accumulated wealth. Conversely, if you have a longer time horizon, you may consider taking on more risk to potentially achieve higher returns. Additionally, it's crucial to stay informed about changes in the market and economic conditions. Keep up with financial news, consult with a financial advisor if needed, and stay educated about investment strategies that align with your goals. 10.1.5 The benefits of compound interest in financial planning. Incorporating compound interest into your financial plans offers several benefits. Firstly, it allows you to harness the power of time. The longer your money compounds, the greater the potential for exponential growth. By starting early and staying consistent, you can take advantage of compounding over extended periods. Secondly, compound interest can help you achieve financial independence. By consistently saving and investing, you can build a nest egg that generates passive income, allowing you to cover your expenses without relying solely on active work income. Lastly, compound interest provides a cushion against inflation. As the value of money decreases over time due to inflation, the growth of your investments can help preserve your purchasing power and maintain your standard of living. In conclusion, incorporating compound interest into your financial plans is a powerful strategy for long-term wealth accumulation. By understanding the basics of compound interest, setting clear financial goals, creating a compound interest strategy, and regularly monitoring and adjusting your plans, you can maximize the benefits of compound interest and set yourself up for a financially secure future. 10.2 Setting financial goals with compound interest. Setting financial goals is an essential step in achieving financial success. When it comes to compounding wealth, understanding the power of compound interest is crucial in setting effective financial goals. Compound interest allows your money to grow exponentially over time, and by harnessing its potential, you can create a solid foundation for your financial future. 10.2.1 The importance of setting financial goals. Before diving into the specifics of setting financial goals with compound interest, it is essential to understand why setting goals is so important. Without clear objectives, it becomes challenging to stay focused and motivated on your financial journey. Setting financial goals provides direction, purpose, and a roadmap to guide your financial decisions. Financial goals can vary from person to person, depending on individual circumstances and aspirations. Some common financial goals include saving for retirement, buying a home, paying off debt, starting a business, or funding your children's education. Whatever your goals may be, incorporating compound interest into your financial plans can significantly enhance your ability to achieve them. 10.2.2 Understanding the power of compound interest in goal setting. Compound interest is often referred to as the eighth wonder of the world, because of its remarkable ability to grow your money exponentially over time. It is the process of earning interest on both the initial principal amount and the accumulated interest from previous periods. This compounding effect can have a profound impact on your financial goals. When setting financial goals, it is crucial to consider the time horizon and the potential growth that compound interest can provide. The longer your money remains invested, the more time it has to compound and grow. By starting early and allowing your investments to compound over several years or even decades, you can harness the full power of compound interest. 10.2.3 Steps to setting financial goals with compound interest. To effectively set financial goals with compound interest, follow these steps. Step 1. Define your financial goals. Start by clearly defining your financial goals. Be specific about what you want to achieve, whether it's saving a certain amount for retirement, paying off a specific debt, or accumulating a down payment for a home. The more precise your goals, the easier it will be to track your progress and make necessary adjustments along the way. Step 2. Determine the time horizon. Next, determine the time horizon for each goal. Consider when you would like to achieve each goal and how much time you have until then. The longer the time horizon, the more significant the impact of compound interest. This step will help you prioritize your goals and allocate resources accordingly. Step 3. Calculate the required savings or investment amount. Once you have defined your goals and determined the time horizon, calculate the required savings or investment amount. Consider the rate of return you expect to earn on your investments and use compound interest formulas or online calculators to determine how much you need to save or invest regularly to reach your goals. Step 4. Develop a savings or investment plan. Based on the required savings or investment amount, develop a plan to achieve your goals. Determine how much you need to save or invest each month or year and create a budget that allows for these contributions. Automating your savings or investment contributions can help ensure consistency and discipline in reaching your goals. Step 5. Monitor and adjust your plan. Regularly monitor your progress towards your financial goals and make necessary adjustments along the way. Life circumstances and market conditions may change, requiring you to adapt your plan. Stay informed about your investments, review your portfolio periodically, and make any necessary changes to keep your plan on track. 10.2.4 The psychological aspect of goal setting. Setting financial goals with compound interest not only has a practical impact on your wealth accumulation but also plays a significant role in your mindset and motivation. Having clear goals provides a sense of purpose and direction, making it easier to stay focused and disciplined in your financial journey. Additionally, setting financial goals with compound interest allows you to visualize the long-term benefits of your efforts. Seeing the potential growth of your investments over time can be incredibly motivating and reinforce the importance of staying committed to your goals. 10.2.5 Celebrating milestones and reassessing goals. As you progress towards your financial goals, it is essential to celebrate milestones along the way. Recognizing and rewarding yourself for reaching certain milestones can help maintain motivation and keep you on track. However, it is equally important to reassess your goals periodically. Life circumstances and priorities may change over time, requiring you to adjust your financial goals. Regularly reassessing your goals allows you to ensure they remain relevant and aligned with your current situation. It also provides an opportunity to set new goals or expand existing ones as you achieve milestones and gain confidence in your financial journey. In conclusion, setting financial goals with compound interest is a powerful strategy for compounding wealth. By understanding the potential of compound interest and following a structured goal-setting process, you can create a roadmap to financial success. Remember to define your goals, determine the time horizon, calculate the required savings or investment amount, develop a plan, and regularly monitor and adjust your progress. With discipline, patience, and a long-term perspective, you can leverage compound interest to achieve your financial aspirations. 10.3 Creating a compound interest strategy. Creating a compound interest strategy is essential for maximizing the growth of your investments and achieving your financial goals. By understanding the principles of compound interest and implementing a well-thought-out plan, you can harness the power of compounding to build wealth over time. In this section, we will explore the key steps involved in creating an effective compound interest strategy. 10.3.1 Define your financial goals. The first step in creating a compound interest strategy is to clearly define your financial goals. Whether you are saving for retirement, a down payment on a house, or your children's education, having specific goals will help guide your investment decisions. Determine the amount of money you need to achieve each goal and the time frame in which you want to accomplish it. 10.3.2 Assess your risk tolerance. Before developing your compound interest strategy, it is important to assess your risk tolerance. Risk tolerance refers to your ability and willingness to withstand fluctuations in the value of your investments. Consider your age, financial situation, and investment objectives when determining your risk tolerance. Younger individuals with a longer time horizon may be more comfortable taking on higher levels of risk, while those nearing retirement may prefer a more conservative approach. 10.3.3 Determine your investment horizon. Your investment horizon is the length of time you plan to invest your money. It is a crucial factor in determining your compound interest strategy. Longer investment horizons allow for greater compounding effects, as your investments have more time to grow. Consider your financial goals and the time frame in which you need to achieve them when determining your investment horizon. 10.3.4 Allocate your assets. Once you have defined your financial goals, assessed your risk tolerance, and determined your investment horizon, the next step is to allocate your assets. Asset allocation involves dividing your investment portfolio among different asset classes, such as stocks, bonds, and cash equivalents. The goal is to create a diversified portfolio that balances risk and return based on your financial goals and risk tolerance. 10.3.5 Choose the right investments. Choosing the right investments is crucial for the success of your compound interest strategy. Consider your risk tolerance, investment horizon, and financial goals when selecting investments. Stocks have historically provided higher returns over the long term but come with higher volatility. Bonds, on the other hand, offer more stability but lower potential returns. It is important to diversify your investments across different asset classes to mitigate risk. 10.3.6 Regularly contribute to your investments. Consistent contributions to your investments are key to maximizing the benefits of compound interest. Set up a systematic investment plan that allows you to contribute a fixed amount of money regularly. By investing regularly, you take advantage of dollar-cost averaging, which can help smooth out the impact of market fluctuations and potentially increase your overall returns. 10.3.7 Rebalance your portfolio. As market conditions change, the value of your investments may fluctuate, causing your asset allocation to deviate from your original plan. It is important to periodically rebalance your portfolio to maintain your desired asset allocation. Rebalancing involves selling overperforming assets and buying underperforming assets to bring your portfolio back in line with your target allocation. This disciplined approach ensures that you are not taking on excessive risk or missing out on potential returns. 10.3.8 Monitor and adjust your strategy. Creating a compound interest strategy is not a one-time event. It requires ongoing monitoring and adjustment to ensure that you stay on track to achieve your financial goals. Regularly review your portfolio performance, reassess your risk tolerance, and make any necessary adjustments to your investment strategy. Life circumstances and market conditions can change, so it is important to adapt your strategy accordingly. 10.3.9 Seek professional advice. If you are unsure about creating a compound interest strategy or need assistance in managing your investments, consider seeking professional advice. A financial advisor can help you assess your financial goals, determine your risk tolerance, and develop a personalized compound interest strategy. They can also provide guidance on investment selection, asset allocation, and portfolio rebalancing. In conclusion, creating a compound interest strategy is crucial for maximizing the growth of your investments and achieving your financial goals. By defining your financial goals, assessing your risk tolerance, determining your investment horizon, allocating your assets, choosing the right investments, regularly contributing to your investments, rebalancing your portfolio, and monitoring and adjusting your strategy, you can harness the power of compound interest to build wealth over time. Remember, consistency and discipline are key to long-term success. 10.4 Monitoring and adjusting compound interest plans. Once you have created a compound interest plan and set it into motion, it is crucial to regularly monitor and adjust your plan to ensure that it continues to align with your financial goals. Monitoring and adjusting your compound interest plans will help you stay on track and make any necessary changes to optimize your wealth accumulation. 10.4.1 Regular monitoring. Regular monitoring of your compound interest plans involves keeping a close eye on the performance of your investments and the progress you are making towards your financial goals. This monitoring process can be done on a monthly, quarterly, or annual basis, depending on your preference and the complexity of your investment portfolio. One important aspect of monitoring is reviewing the performance of your investments. This includes analyzing the returns generated by your investments and comparing them to your expectations and benchmarks. By regularly reviewing the performance, you can identify any underperforming investments and take appropriate action, such as reallocating your portfolio or seeking professional advice. In addition to investment performance, it is also essential to monitor the contributions you are making towards your compound interest plans. Regularly reviewing your contributions will help ensure that you are consistently saving and investing according to your financial plan. If you find that you are not meeting your contribution targets, you may need to adjust your budget or find ways to increase your income to stay on track. 10.4.2 Adjusting your compound interest plans. Adjusting your compound interest plans is a necessary step to ensure that your strategy remains effective and aligned with your financial goals. There are several factors to consider when making adjustments. 10.4.2.1 Changes in financial goals. Over time, your financial goals may change due to various factors such as career advancements, family circumstances, or shifts in personal priorities. It is important to regularly reassess your goals and make adjustments to your compound interest plans accordingly. For example, if you decide to retire earlier than planned, you may need to increase your savings rate or adjust your investment strategy to achieve your new retirement goal. 10.4.2.2 Market conditions. Market conditions can have a significant impact on the performance of your investments. It is crucial to stay informed about market trends and adjust your investment strategy accordingly. During periods of market volatility or economic downturns, it may be necessary to reassess your risk tolerance and make adjustments to your portfolio allocation. Similarly, during periods of favorable market conditions, you may consider taking advantage of investment opportunities to maximize your returns. 10.4.2.3 Life events. Life events such as marriage, the birth of a child, or purchasing a home can have financial implications that may require adjustments to your compound interest plans. For example, starting a family may necessitate increasing your savings rate or adjusting your investment strategy to accommodate the additional financial responsibilities. It is important to regularly evaluate how these life events impact your financial situation and make the necessary adjustments to your plans. 10.4.2.4 Changes in risk tolerance. Your risk tolerance may change over time due to various factors such as age, financial stability, or personal circumstances. It is essential to periodically reassess your risk tolerance and adjust your investment strategy accordingly. As you approach retirement, for example, you may choose to shift your investments towards more conservative options to protect your accumulated wealth. 10.4.3 Seeking professional advice. Monitoring and adjusting compound interest plans can be complex, especially for individuals with limited financial knowledge or those with complex investment portfolios. In such cases, seeking professional advice from a financial advisor or wealth manager can be beneficial. These professionals can provide expert guidance, help you monitor your investments, and make informed adjustments to your compound interest plans based on your financial goals and risk tolerance. Remember, compound interest plans are not set in stone. They require regular monitoring and adjustments to ensure they remain effective and aligned with your financial goals. By staying proactive and making necessary changes, you can maximize the potential of compound interest and achieve long-term financial success. 11. Compound interest and risk management. 11.1 Understanding risk in compound interest investments. Compound interest is a powerful tool for wealth accumulation, but it is important to understand that it is not without risks. In this section, we will explore the various risks associated with compound interest investments and how to manage them effectively. 11.1.1 The nature of risk. Before delving into the specific risks associated with compound interest investments, it is crucial to understand the nature of risk itself. Risk refers to the possibility of losing some or all of the invested capital or not achieving the expected returns. In the context of compound interest investments, risk can arise from various factors such as market volatility, economic conditions, and individual investment choices. 11.1.2 Market risk. One of the primary risks associated with compound interest investments is market risk. Market risk refers to the potential for investments to decline in value due to factors such as economic downturns, changes in market conditions, or fluctuations in interest rates. This risk is inherent in all investment vehicles, including stocks, bonds, mutual funds, and real estate. To mitigate market risk, it is essential to diversify your investment portfolio. Diversification involves spreading your investments across different asset classes, industries, and geographic regions. By diversifying, you reduce the impact of any single investment on your overall portfolio. This strategy helps to cushion the impact of market fluctuations and reduces the risk of significant losses. 11.1.3 Interest rate risk. Interest rate risk is another significant risk to consider when investing in compound interest vehicles. Interest rates can have a significant impact on the value of investments, particularly fixed income securities such as bonds. When interest rates rise, the value of existing bonds decreases, as newer bonds offer higher yields. Conversely, when interest rates fall, the value of existing bonds increases. To manage interest rate risk, it is crucial to understand the duration of your investments. Duration measures the sensitivity of a bond's price to changes in interest rates. Bonds with longer durations are more sensitive to interest rate changes, while those with shorter durations are less affected. By matching the duration of your bond investments with your investment horizon, you can minimize the impact of interest rate fluctuations. 11.1.4 Credit risk. Credit risk refers to the possibility of a borrower defaulting on their debt obligations. When investing in bonds or other fixed income securities, there is always a risk that the issuer may fail to make interest payments or repay the principal amount. This risk is particularly relevant when investing in lower-rated bonds or corporate bonds. To manage credit risk, it is essential to conduct thorough research on the creditworthiness of the issuer before investing. Credit ratings provided by reputable rating agencies can serve as a useful indicator of an issuer's ability to meet its financial obligations. Additionally, diversifying your bond investments across different issuers and sectors can help mitigate the impact of any single default. 11.1.5 Inflation risk. Inflation risk refers to the potential for the purchasing power of money to decrease over time. Inflation erodes the value of future cash flows, reducing the real return on investments. This risk is particularly relevant for long-term compound interest investments, as the effects of inflation can compound over time. To protect against inflation risk, it is important to consider investments that have the potential to outpace inflation. Historically, stocks and real estate have provided returns that have exceeded inflation over the long term. By including these asset classes in your investment portfolio, you can help preserve the purchasing power of your wealth. 11.1.6 Liquidity risk. Liquidity risk refers to the possibility of not being able to quickly convert an investment into cash without incurring significant losses. Some investments, such as real estate or certain types of bonds, may have limited liquidity, making it challenging to sell them quickly at fair market value. To manage liquidity risk, it is important to maintain a portion of your investment portfolio in liquid assets such as cash or highly liquid securities. This ensures that you have readily available funds to meet any unexpected expenses or take advantage of investment opportunities that may arise. 11.1.7 Conclusion. Understanding the risks associated with compound interest investments is crucial for successful wealth accumulation. By diversifying your portfolio, managing interest rate and credit risks, protecting against inflation, and maintaining liquidity, you can effectively manage the risks and maximize the potential returns of your compound interest investments. Remember, risk is an inherent part of investing, but with careful planning and risk management strategies, you can navigate the investment landscape with confidence. 11.2 Diversification and compound interest. Diversification is a key strategy in managing risk and maximizing returns when it comes to compound interest investments. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the impact of any single investment on your overall portfolio. This section will explore the importance of diversification in the context of compound interest and provide practical tips on how to effectively diversify your investments. 11.2.1 The importance of diversification. Diversification is often referred to as the Only free lunch in investing because it allows you to potentially increase returns while reducing risk. When you diversify your investments, you are essentially spreading your risk across different assets, which helps to mitigate the impact of any individual investment performing poorly. By doing so, you can protect your portfolio from significant losses and increase the likelihood of achieving long-term financial goals. Compound interest works best when it is applied to a diversified portfolio. By investing in a variety of assets, you can take advantage of the power of compounding across different sectors and industries. This approach allows you to capture the growth potential of different areas of the market while minimizing the risk associated with any single investment. 11.2.2 Strategies for Diversification. To effectively diversify your investments, it is important to consider a few key strategies. 11.2.2.1 Asset allocation. Asset allocation refers to the distribution of your investments across different asset classes, such as stocks, bonds, real estate, and cash. The goal is to create a balanced portfolio that aligns with your risk tolerance and financial goals. By diversifying across different asset classes, you can reduce the impact of market volatility on your overall portfolio. 11.2.2.2 Geographic diversification. Geographic diversification involves investing in different countries and regions around the world. By spreading your investments across different economies, you can reduce the risk associated with any single country's economic performance. This strategy allows you to take advantage of growth opportunities in emerging markets while also benefiting from the stability of developed economies. 11.2.2.3 Sector diversification. Sector diversification involves investing in different industries or sectors of the economy. By spreading your investments across sectors such as technology, healthcare, finance, and consumer goods, you can reduce the impact of any single industry's performance on your portfolio. This strategy allows you to capture the growth potential of different sectors while minimizing the risk associated with any one sector. 11.2.2.4 Investment types. Diversification can also be achieved by investing in different types of assets, such as stocks, bonds, mutual funds, and real estate. Each asset class has its own risk and return characteristics, and by diversifying across different types of investments, you can reduce the overall risk of your portfolio. This strategy allows you to benefit from the potential growth of stocks while also providing stability through bonds and real estate. 11.2.3 Benefits of diversification. Diversification offers several benefits when it comes to compound interest investments. 11.2.3.1 Risk reduction. By diversifying your investments, you can reduce the risk of significant losses. If one investment performs poorly, the impact on your overall portfolio will be minimized because you have other investments that may perform well. Diversification helps to smooth out the ups and downs of individual investments, providing a more stable and predictable return over time. 11.2.3.2 Increased return potential. Diversification not only reduces risk but also increases the potential for higher returns. By investing in a variety of assets, you can capture the growth potential of different sectors and industries. This approach allows you to benefit from the compounding effect across a diversified portfolio, potentially leading to higher overall returns. 11.2.3.3 Preservation of capital. Diversification helps to preserve your capital by reducing the impact of any single investment on your portfolio. By spreading your investments across different assets, you can protect yourself from significant losses and ensure that your capital is preserved over the long term. This is particularly important when it comes to compound interest investments, as the power of compounding relies on the preservation of capital. 11.2.4 Monitoring and rebalancing. Diversification is not a one-time event but an ongoing process. It is important to regularly monitor your portfolio and make adjustments as needed to maintain the desired level of diversification. This involves periodically reviewing your asset allocation, geographic distribution, and sector exposure to ensure that they align with your investment goals and risk tolerance. Rebalancing is another important aspect of diversification. Over time, the performance of different investments within your portfolio may vary, causing your asset allocation to deviate from your original plan. Rebalancing involves selling investments that have performed well and buying more of those that have underperformed, bringing your portfolio back to its desired allocation. This helps to maintain the intended level of diversification and ensures that your portfolio remains aligned with your long-term goals. Conclusion. Diversification is a crucial component of successful compound interest investing. By spreading your investments across different asset classes, geographic regions, and sectors, you can reduce risk, increase return potential, and preserve your capital. Regular monitoring and rebalancing are essential to maintaining the desired level of diversification and ensuring that your portfolio remains aligned with your financial goals. By incorporating diversification into your compound interest strategy, you can enhance the power of compounding and increase your chances of long-term financial success. 11.3 Managing risk with compound interest. Managing risk is an essential aspect of any investment strategy, and compound interest is no exception. While compound interest can be a powerful tool for wealth accumulation, it is important to understand and mitigate the risks associated with it. In this section, we will explore various strategies for managing risk when utilizing compound interest. 11.3.1 Diversification and asset allocation. One of the most effective ways to manage risk in compound interest investments is through diversification and asset allocation. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and mutual funds. By diversifying your portfolio, you reduce the impact of any single investment on your overall returns. Asset allocation, on the other hand, refers to the distribution of your investments within each asset class. It involves determining the percentage of your portfolio allocated to different types of investments based on your risk tolerance and financial goals. A well-diversified portfolio with a balanced asset allocation can help mitigate the risk of significant losses and provide more stable returns over time. 11.3.2 Risk Assessment and Risk Tolerance. Before embarking on any investment strategy involving compound interest, it is crucial to assess your risk tolerance. Risk tolerance refers to your ability and willingness to withstand fluctuations in the value of your investments. Understanding your risk tolerance will help you determine the level of risk you are comfortable taking on and guide your investment decisions. Different investments carry varying levels of risk. Stocks, for example, tend to be more volatile and carry a higher risk compared to bonds or savings accounts. By assessing your risk tolerance, you can align your investment choices with your comfort level and avoid taking on excessive risk that may lead to significant losses. 11.3.3 Regular monitoring and rebalancing. Managing risk with compound interest requires regular monitoring and rebalancing of your investment portfolio. Markets and economic conditions are constantly changing, and the performance of different asset classes can vary over time. By regularly reviewing your portfolio, you can ensure that your investments are still aligned with your risk tolerance and financial goals. Rebalancing involves adjusting the allocation of your investments to maintain the desired asset mix. For example, if the value of your stocks increases significantly, it may lead to an overweighting of stocks in your portfolio. Rebalancing would involve selling some stocks and reinvesting the proceeds in other asset classes to restore the desired allocation. This helps to manage risk by preventing your portfolio from becoming too heavily weighted in one particular investment. 11.3.4 Risk Management Tools and Strategies. There are various risk management tools and strategies that can be employed when utilizing compound interest. One such tool is stop-loss orders, which allow you to set a predetermined price at which a security will be automatically sold if it falls below that level. This can help limit potential losses in case of a significant market downturn. Another strategy is dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps to mitigate the impact of market volatility by buying more shares when prices are low and fewer shares when prices are high. Over time, this can result in a lower average cost per share and reduce the impact of short-term market fluctuations. 11.3.5 Importance of emergency funds. When utilizing compound interest for wealth accumulation, it is important to have an emergency fund in place. An emergency fund is a separate savings account that is easily accessible and contains enough funds to cover unexpected expenses or financial emergencies. Having an emergency fund provides a safety net and helps to mitigate the risk of having to liquidate long-term investments prematurely. By having an emergency fund, you can avoid tapping into your compound interest investments during times of financial distress, allowing them to continue growing undisturbed. It provides peace of mind and ensures that you have a cushion to fall back on in case of unforeseen circumstances. 11.3.6 Seeking professional advice. Managing risk with compound interest can be complex, and it is always advisable to seek professional advice when making investment decisions. Financial advisors can provide valuable insights and guidance based on their expertise and experience. They can help assess your risk tolerance, develop a suitable investment strategy, and provide ongoing monitoring and support. Professional advice can help you navigate the complexities of the investment landscape and make informed decisions that align with your financial goals and risk tolerance. It is important to choose a reputable and qualified financial advisor who has a fiduciary duty to act in your best interest. In conclusion, managing risk is a crucial aspect of utilizing compound interest for wealth accumulation. By diversifying your portfolio, assessing your risk tolerance, regularly monitoring and rebalancing, employing risk management tools and strategies, maintaining an emergency fund, and seeking professional advice, you can effectively manage risk and maximize the potential of compound interest in achieving your financial goals. 11.4 Insurance and compound interest. Insurance plays a crucial role in managing risk and protecting our financial well-being. When it comes to compound interest, insurance can have both direct and indirect impacts on our wealth accumulation and financial planning. In this section, we will explore the relationship between insurance and compound interest, and how insurance can be utilized to enhance our financial strategies. 11.4.1 The importance of insurance. Insurance is a financial tool that provides protection against potential risks and uncertainties. It offers peace of mind by transferring the financial burden of unexpected events to an insurance company. By paying regular premiums, individuals and businesses can safeguard themselves against various risks, such as property damage, medical expenses, liability claims, and even loss of life. The primary purpose of insurance is to mitigate the financial impact of unforeseen events. Without insurance, individuals would have to bear the full cost of these events, which can be financially devastating. By spreading the risk among a large pool of policyholders, insurance companies can provide coverage at a fraction of the potential loss. 11.4.2 Insurance and compound interest. Compound interest can have a significant impact on the value of insurance policies. Insurance companies invest the premiums they collect from policyholders to generate returns and ensure they have sufficient funds to pay out claims. These investments can include a variety of assets, such as stocks, bonds, real estate, and other financial instruments. The power of compound interest comes into play when insurance companies earn returns on their investments over time. As the investments grow, so does the value of the insurance company's assets. This growth allows insurance companies to offer competitive premiums and provide policyholders with higher coverage amounts. For policyholders, the impact of compound interest can be seen in the form of policy dividends or reduced premiums. Insurance companies that generate significant investment returns can distribute a portion of those returns back to policyholders in the form of dividends. These dividends can be reinvested or used to reduce future premium payments, effectively compounding the value of the policy over time. 11.4.3 Life insurance and compound interest. Life insurance is a type of insurance that provides a death benefit to the beneficiaries upon the insured's passing. It is also an area where compound interest plays a significant role. When individuals purchase permanent life insurance policies, such as whole life or universal life insurance, a portion of their premiums goes towards building cash value within the policy. The cash value component of a life insurance policy grows over time through the power of compound interest. As the cash value accumulates, policyholders can access it through policy loans or withdrawals. These funds can be used for various purposes, such as supplementing retirement income, funding education expenses, or covering emergency expenses. The growth of the cash value component is tax-deferred, meaning policyholders do not pay taxes on the investment gains until they withdraw the funds. This tax advantage, coupled with the compounding effect of interest, can make life insurance policies an attractive long-term savings vehicle. 11.4.4 Property and casualty insurance. Property and casualty insurance, which includes homeowners insurance, auto insurance, and liability insurance, also benefits from compound interest. Insurance companies collect premiums from policyholders to cover potential losses related to property damage, accidents, or legal liabilities. Similar to life insurance, property and casualty insurance companies invest the premiums they receive to generate returns. These returns help offset the costs of claims and operating expenses. The compounding effect of interest allows insurance companies to maintain financial stability and offer competitive premiums to policyholders. For individuals, property and casualty insurance provide protection against unexpected events that could result in significant financial losses. By paying relatively small premiums, individuals can transfer the risk of property damage, theft, or liability claims to the insurance company. This allows them to protect their assets and maintain their financial well-being. 11.4.5 Risk management and compound interest. Insurance and compound interest go hand in hand when it comes to risk management. By having appropriate insurance coverage, individuals can mitigate the financial impact of unforeseen events and protect their wealth accumulation efforts. The compounding effect of interest allows insurance companies to provide coverage at affordable rates while still maintaining their financial stability. When individuals incorporate insurance into their financial planning, they can allocate more of their resources towards long-term investments that have the potential for compound interest growth. By transferring the risk to insurance companies, individuals can focus on building wealth and achieving their financial goals without the constant worry of unexpected financial setbacks. In conclusion, insurance and compound interest are interconnected in various ways. Insurance companies utilize compound interest to generate returns on their investments, which allows them to offer competitive premiums and provide policyholders with higher coverage amounts. For individuals, insurance provides protection against potential risks and uncertainties, allowing them to focus on wealth accumulation and long-term financial planning. By understanding the relationship between insurance and compound interest, individuals can make informed decisions to safeguard their financial well-being and achieve their financial goals. 12. Compound interest and wealth accumulation. 12.1 Compound interest and generational wealth. Compound interest is a powerful financial concept that has the potential to create generational wealth. By understanding and harnessing the power of compound interest, individuals can build a strong financial foundation that can benefit not only themselves but also future generations. 12.1.1 The magic of compound interest. Compound interest is often referred to as the eighth wonder of the world, because of its ability to exponentially grow wealth over time. It is the process of earning interest on both the initial principal amount and the accumulated interest from previous periods. This compounding effect can significantly boost the growth of investments and savings. The magic of compound interest lies in its ability to generate returns on top of returns. As the interest earned is reinvested, it starts to earn interest itself, leading to a snowball effect. Over time, this compounding effect can result in substantial wealth accumulation. 12.1.2 Starting early for maximum impact. One of the key factors in harnessing the power of compound interest for generational wealth is starting early. The earlier individuals begin investing or saving, the longer their money has to compound and grow. Time is a crucial element in the equation of compound interest. By starting early, individuals can take advantage of the compounding effect over a longer period. Even small contributions made consistently over time can lead to significant wealth accumulation. This is why it is essential to instill the importance of saving and investing in future generations from an early age. 12.1.3 Passing on the knowledge. To create generational wealth through compound interest, it is crucial to pass on the knowledge and understanding of this financial concept to future generations. By educating children and grandchildren about the power of compound interest, individuals can empower them to make informed financial decisions and set them on a path towards financial success. Teaching the principles of saving, investing, and the benefits of compound interest can provide a solid foundation for future generations. By instilling good financial habits and knowledge, individuals can help their loved ones make wise financial choices that will benefit them throughout their lives. 12.1.4 Creating a legacy. Compound interest can be a powerful tool for creating a lasting legacy. By consistently investing or saving over time, individuals can accumulate significant wealth that can be passed down to future generations. This can provide financial security and opportunities for their descendants. Creating a legacy through compound interest involves careful planning and consideration. It may involve setting up trust funds, establishing investment accounts, or creating a family financial plan. By working with financial advisors and estate planners, individuals can ensure that their wealth is preserved and distributed according to their wishes. 12.1.5 Investing for the long term. To maximize the potential of compound interest for generational wealth, it is important to adopt a long-term investment mindset. Investing in assets that have the potential to grow steadily over time, such as stocks, real estate, or mutual funds, can provide the necessary returns for wealth accumulation. Long-term investing allows individuals to ride out market fluctuations and benefit from the compounding effect. By staying invested and reinvesting dividends or interest earned, individuals can take full advantage of the power of compound interest. 12.1.6 Diversification and risk management. While compound interest can be a powerful tool for wealth accumulation, it is essential to consider risk management and diversification. Diversifying investments across different asset classes and sectors can help mitigate risk and protect wealth from market volatility. By spreading investments across various assets, individuals can reduce the impact of any single investment's performance on their overall portfolio. This can help preserve wealth and ensure that future generations are not overly exposed to any one investment. 12.1.7 Balancing wealth accumulation and enjoyment. While the goal of generational wealth is to provide financial security and opportunities for future generations, it is also important to strike a balance between wealth accumulation and enjoying the present. It is essential to find a balance between saving and investing for the future and enjoying the fruits of one's labor in the present. By finding this balance, individuals can create a legacy of financial stability and prosperity while also enjoying the benefits of their hard work. This balance can help ensure that future generations not only inherit wealth but also the values and experiences that come with it. In conclusion, compound interest has the potential to create generational wealth by harnessing the power of compounding over time. By starting early, passing on knowledge, and making informed investment decisions, individuals can build a strong financial foundation that can benefit future generations. It is important to balance wealth accumulation with enjoying the present and to consider risk management and diversification to protect and preserve wealth for the long term. 12.2 Compound interest and financial freedom. Financial freedom is a goal that many individuals strive to achieve. It represents the ability to live a life free from financial constraints and to have the resources to pursue one's passions and dreams. Compound interest plays a crucial role in attaining financial freedom, as it has the power to exponentially grow wealth over time. 12.2.1 The magic of compound interest. Compound interest is often referred to as the eighth wonder of the world, and for good reason. It is a concept that allows individuals to earn interest not only on their initial investment but also on the accumulated interest over time. This compounding effect can lead to significant wealth accumulation and ultimately financial freedom. The key to harnessing the power of compound interest lies in starting early and allowing time to work its magic. The longer the investment horizon, the greater the potential for exponential growth. By reinvesting the interest earned, individuals can benefit from the compounding effect, which accelerates the growth of their wealth. 12.2.2 The role of saving and investing. To achieve financial freedom through compound interest, it is essential to adopt a disciplined approach to saving and investing. Saving a portion of one's income and consistently investing it in vehicles that generate compound interest is the foundation for building wealth. One of the most effective ways to leverage compound interest is through long-term investing. By investing in assets such as stocks, bonds, mutual funds, and real estate, individuals can take advantage of the power of compounding over extended periods. These investments have the potential to generate higher returns compared to traditional savings accounts, which typically offer lower interest rates. 12.2.3 The power of consistency. Consistency is a crucial factor in harnessing the full potential of compound interest. Regularly contributing to investments and reinvesting the returns allows individuals to maximize the compounding effect. By staying committed to a long-term investment strategy, individuals can benefit from the growth of their investments over time. Automating savings and investment contributions can help maintain consistency. Setting up automatic transfers from a paycheck to an investment account ensures that funds are consistently allocated towards wealth accumulation. This approach eliminates the temptation to spend the money and reinforces the habit of saving and investing. 12.2.4 The importance of patience. Patience is a virtue when it comes to compound interest and financial freedom. It takes time for the compounding effect to generate substantial wealth. It is crucial to resist the urge for instant gratification and focus on the long-term goals. By staying patient and allowing investments to grow over time, individuals can benefit from the exponential growth potential of compound interest. It is important to remember that compound interest is a long-term strategy and requires perseverance to reap its full rewards. 12.2.5 The power of reinvestment. Reinvesting the returns generated by compound interest is a key strategy for accelerating wealth accumulation. By reinvesting the interest earned, individuals can compound their returns and generate even higher levels of wealth. For example, in the case of dividend-paying stocks, reinvesting the dividends back into the stock allows for the purchase of additional shares. Over time, this reinvestment can significantly increase the overall investment value and generate higher dividend payments. 12.2.6 The impact of compound interest on financial independence. Compound interest plays a vital role in achieving financial independence. By consistently saving and investing, individuals can accumulate wealth that generates passive income streams. This passive income can provide the financial means to cover living expenses without relying on traditional employment. Financial independence allows individuals to have more control over their time and pursue activities that bring them joy and fulfillment. It provides the freedom to make choices based on personal preferences rather than financial constraints. 12.2.7 Creating a compound interest strategy for financial freedom. To create a compound interest strategy for financial freedom, it is important to set clear financial goals and develop a plan to achieve them. This involves determining the desired level of wealth, the time horizon for achieving it, and the appropriate investment vehicles to utilize. Diversification is also a crucial aspect of a compound interest strategy. By spreading investments across different asset classes and sectors, individuals can mitigate risk and maximize potential returns. This diversification helps protect against market fluctuations and ensures a more stable growth trajectory. Regularly monitoring and adjusting the compound interest strategy is essential to stay on track towards financial freedom. As circumstances change, it may be necessary to reassess goals, adjust investment allocations, or explore new opportunities. Staying informed and seeking professional advice can help individuals make informed decisions and optimize their compound interest strategy. 12.2.8 The path to financial freedom. Compound interest is a powerful tool that can pave the way to financial freedom. By understanding its principles and implementing a disciplined approach to saving and investing, individuals can harness the compounding effect to accumulate wealth over time. Financial freedom is not an overnight achievement but rather a journey that requires patience, consistency, and a long-term perspective. By staying committed to the compound interest strategy and adapting it as needed, individuals can gradually build wealth and ultimately enjoy the freedom to live life on their own terms. 12.3 Compound interest and wealth preservation. Preserving wealth is a crucial aspect of financial planning, and compound interest plays a significant role in achieving this goal. While compound interest is often associated with wealth accumulation, it is equally important for wealth preservation. In this section, we will explore how compound interest can be utilized to preserve and protect your wealth over time. 12.3.1 The power of compound interest in wealth preservation. Compound interest is a powerful force that can work in your favor when it comes to preserving wealth. By reinvesting the interest earned on your investments, you can benefit from compounding over time. This compounding effect allows your wealth to grow exponentially, providing a cushion against inflation and ensuring the preservation of your purchasing power. When it comes to wealth preservation, it is essential to consider the impact of inflation. Inflation erodes the value of money over time, making it crucial to find ways to counteract its effects. By harnessing the power of compound interest, you can potentially outpace inflation and maintain the value of your wealth. 12.3.2 Diversification is a wealth preservation strategy. Diversification is a key strategy for wealth preservation, and compound interest can play a role in this approach. By diversifying your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you can spread your risk and protect your wealth from market volatility. Compound interest can help preserve wealth in a diversified portfolio by generating consistent returns over time. By reinvesting the interest earned from various investments, you can ensure the growth and stability of your wealth. This approach allows you to mitigate the impact of any underperforming investments and maintain a steady income stream. 12.3.3 Long-term investing for wealth preservation. Long-term investing is another crucial aspect of wealth preservation, and compound interest aligns perfectly with this strategy. By taking a long-term approach to investing, you can benefit from the compounding effect of interest over an extended period. When you invest for the long term, you allow your investments to weather short-term market fluctuations and benefit from the overall growth of the market. By reinvesting the interest earned, you can maximize the compounding effect and ensure the preservation of your wealth. 12.3.4 Preservation of principal with compound interest. Preserving the principal amount is a fundamental objective when it comes to wealth preservation. Compound interest can help in achieving this goal by generating consistent returns on your investments while keeping the principal intact. By reinvesting the interest earned, you can ensure that your principal amount remains untouched while still benefiting from the growth of your investments. This approach provides a reliable source of income while preserving the core value of your wealth. 12.3.5 Compound interest and risk management. Risk management is an integral part of wealth preservation, and compound interest can be a valuable tool in this regard. By diversifying your investments and reinvesting the interest earned, you can mitigate the impact of any potential losses and protect your wealth from significant market downturns. Compound interest allows you to generate consistent returns over time, even if some of your investments underperform. This approach helps to minimize the overall risk in your portfolio and ensures the preservation of your wealth. 12.3.6 Estate planning and compound interest. Estate planning is a critical aspect of wealth preservation, and compound interest can play a significant role in this process. By utilizing compound interest, you can create a robust financial plan that ensures the smooth transfer of wealth to future generations. By reinvesting the interest earned, you can grow your wealth over time and create a substantial estate. This approach allows you to leave a lasting legacy for your loved ones while preserving the value of your wealth. 12.3.7 Professional guidance for wealth preservation. Wealth preservation is a complex process that requires careful planning and professional guidance. Consulting with a financial advisor or wealth manager can help you develop a comprehensive strategy that incorporates compound interest into your wealth preservation plan. A financial professional can assess your financial goals, risk tolerance, and time horizon to create a tailored plan that maximizes the benefits of compound interest. They can also provide guidance on diversification, long-term investing, and risk management to ensure the preservation of your wealth. In conclusion, compound interest is not only a powerful tool for wealth accumulation but also a crucial factor in wealth preservation. By harnessing the compounding effect, diversifying your investments, and taking a long-term approach, you can preserve and protect your wealth over time. With careful planning and professional guidance, compound interest can be a valuable asset in your journey towards financial security and prosperity. 12.4 Compound interest and philanthropy. Philanthropy is the act of giving back to society and making a positive impact on the lives of others. It is a noble endeavor that can bring about significant change and improve the well-being of communities and individuals. When combined with the power of compound interest, philanthropy can have an even greater and lasting effect. 12.4.1 The impact of compound interest on philanthropy. Compound interest, as we have discussed throughout this book, is the concept of earning interest on both the initial investment and the accumulated interest over time. It is a powerful force that can exponentially grow wealth. When applied to philanthropy, compound interest can magnify the impact of charitable giving. By investing funds earmarked for philanthropic purposes, individuals and organizations can generate returns that can be reinvested into their charitable endeavors. Over time, these returns can compound, allowing for larger and more impactful contributions. This compounding effect can help philanthropists achieve their goals more quickly and sustainably. 12.4.2 Creating a philanthropic investment strategy. To leverage the power of compound interest for philanthropy, it is essential to develop a well-thought-out investment strategy. This strategy should align with the philanthropist's values and goals while also considering the potential for long-term growth. When creating a philanthropic investment strategy, it is crucial to diversify the portfolio to mitigate risk and maximize returns. By investing in a mix of asset classes, such as stocks, bonds, real estate, and mutual funds, philanthropists can benefit from the growth potential of different sectors while minimizing the impact of market fluctuations. Additionally, philanthropists should consider investing in socially responsible funds or impact investing. These investment vehicles allow individuals to support companies and projects that align with their philanthropic goals while still generating financial returns. By investing in companies that prioritize environmental sustainability, social justice, or other causes, philanthropists can make a positive impact both financially and socially. 12.4.3 Establishing a philanthropic foundation. One way to ensure the long-term sustainability of philanthropic efforts is by establishing a philanthropic foundation. A foundation provides a structured and organized approach to giving, allowing for strategic planning and the ability to make a lasting impact. When establishing a foundation, philanthropists can contribute a portion of their wealth and invest it to generate returns. These returns can then be used to fund charitable initiatives and projects. By utilizing the power of compound interest, the foundation's assets can grow over time, allowing for more significant contributions and a lasting legacy of giving. Foundations also provide a platform for collaboration and partnership with other like-minded individuals and organizations. By pooling resources and expertise, philanthropists can amplify their impact and tackle larger-scale projects that may not be achievable individually. 12.4.4 Donor-advised funds and compound interest. Another approach to leveraging compound interest for philanthropy is through donor-advised funds (DAFs). A DAF is a charitable giving vehicle that allows individuals to make contributions to a fund and receive an immediate tax deduction. The funds within the DAF can then be invested, and the donor can recommend grants to charitable organizations over time. By investing the funds within a DAF, donors can benefit from the power of compound interest. The returns generated by the investments can be reinvested or used to support charitable causes. This approach allows donors to have a more significant impact over time, as the funds within the DOF continue to grow through compounding. 12.4.5 Impact Measurement and Evaluation. To ensure the effectiveness and efficiency of philanthropic efforts, it is essential to measure and evaluate the impact of charitable contributions. By tracking the outcomes and assessing the success of various initiatives, philanthropists can make informed decisions about where to allocate resources and how to maximize their impact. When considering the impact of compound interest on philanthropy, it is crucial to evaluate not only the financial returns but also the social and environmental outcomes. By aligning the investment strategy with the desired impact, philanthropists can ensure that their contributions are making a meaningful difference in the world. 12.4.6 Legacy Planning and Philanthropy. Compound interest can also play a significant role in legacy planning and philanthropy. By incorporating philanthropic goals into estate planning, individuals can ensure that their wealth continues to make a positive impact even after they are gone. Through the establishment of charitable trusts or bequests, individuals can allocate a portion of their assets to philanthropic causes. These assets can be invested to generate returns, allowing for ongoing contributions to charitable organizations. The power of compound interest ensures that the impact of these contributions continues to grow over time, creating a lasting legacy of giving. 12.4.7 The Joy of Giving. While compound interest can enhance the impact of philanthropy, it is important to remember that the true joy of giving comes from the act itself. The ability to make a positive difference in the lives of others and contribute to the betterment of society is a reward in itself. By combining the power of compound interest with philanthropy, individuals and organizations can create a sustainable and impactful approach to giving. Whether through foundations, donor-advised funds, or other charitable vehicles, compound interest can amplify the reach and effectiveness of philanthropic efforts, leaving a lasting legacy of generosity and positive change.